We've got a world of higher uncertainty, probably higher volatility, slower growth. You've got to adjust the portfolio accordingly.
It's more likely that we revisit the lows than we don't.
It's going to be hard to find a bullish or optimistic investor right now.
We have to be careful not to read too much into one-day moves and extrapolate them into the future.
What we're looking for is a very choppy year, unfortunately.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Let's get your week started. Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Monday, following the biggest weekly gain of the year so far, the rally resumes as the likes of Apple and Nvidia secure an exemption from so-called reciprocal tariffs. The president warning that any relief might be short-lived, stressing that nobody is getting off the hook.
The tariffs will be in place in the not-distant future because, as you know, like we did with steel, like we did with automobiles, like we did with aluminum, which are now fully on, we'll be doing that with semiconductors, with chips, and numerous other things. And that'll take place in the very near future. I'm going to be announcing it over the next week.
China's Ministry of Commerce urging the United States to take a big stride to completely abolishing the wrongful action. Commerce Secretary Howard Lutnick isn't backing down.
They're exempt from the reciprocal tariffs, but they're included in the semiconductor tariffs, which are coming in probably a month or two.
Did you get all that? So the policy volatility continues, going into a week full of earnings, economic data, and another address from the Fed Chair Jay Powell. And so far, this Federal Reserve isn't blinking.
They don't want to own this because why should they? At a certain point, the policy uncertainty is actually not of their doing this time. And it is hard to know whether it's going to be in the near term, and I stress the near term, the inflationary aspect that's going to be the dominant theme or the growth aspect. I will just say this. Anyone hoping for a trade limit up kind of morning when it comes to tech stocks, you aren't seeing that kind of optimism anywhere. You have, for example, Steve Capria over at Deutsche Bank. This is still a sell rallies environment. Max Kettner, who used to be the biggest bull, coming out and saying we remain skeptically and tactically cautious on risk assets, especially in the U.S.
So we've got earnings data and Chairman Powell. Let's pick up on one Fed official over the weekend, Neil Kashkari of the Minneapolis Fed. I think investors in the U.S. and around the world are trying to determine what is the new normal in America. He goes on to say, we have zero ability to affect that destination.
And he was talking about how J.P. Morgan and BlackRock were talking about how potentially you could see a 5% benchmark 10-year Treasury yield, and that is maybe price discovery. At what point does volatility become dysfunction? That is the ultimate question for a Federal Reserve, when people largely believe they will only intervene if there is market dysfunction. So far, the pipes seem to be working. I read one note over the weekend saying the house is burning down, but the pipes are still functional. There is this feeling right now they aren't going to get involved. They really don't want to get involved. But people don't believe that they won't get involved if you reach a certain level.
Do you want some good news this morning? So last week, 2-year and 10-year saw a move of 40 to 50 basis points higher on bond yields. This morning, Lisa, we're down 5 at the front end. On a 10-year, we're down 5. On a 30-year, we're down 2. Bob Michael of J.P. Morgan Asset Management was looking for this, just a little bit of stability to start the week.
He saw most of the sell-off that was pretty catastrophic last week for the bond market as largely leveraged trade unwinds. And this, to me, is really the ultimate question. How much is this a positioning shock? And how much is this a fundamental reassessment of American assets? Right now, the only caveat to that is the dollar continuing to weaken at a time when it isn't exactly a risk-roaring, risk-on type of moment. But you're right. The fact that there's a bid into treasuries has to be a sigh of relief.
The dollar a whole lot weaker against the euro. Euro-dollar right now, 113.80. Coming up this hour, we'll catch up with Steve Chiavarone of Federated, staying overweight equities. Ed Mills of Raymond James on this weekend's confusion. And Krishna Guha of Evercore on what he calls an ugly combination of market moves. We begin this hour with stocks rising as President Donald Trump pauses tech tariffs. Steve Chiavarone of Federated Hermes staying the course, writing, we're maintaining a modest overweight to equities and are looking for opportunities to upgrade portfolio quality. Steve joins us now for more. Steve, good morning. Good to see you. What do you make of the confusion over the weekend?
We're not done. I mean, I think that's the story. I think what we saw last week were two important things. One, what was the primary objective of the tariffs? And it was clear that the non-negotiable element here was China and the national security element of tariffs. This administration is insecure about our security, particularly when it relates to key goods that we source from China. I think the second thing is we probably, it's a big word, but probably took off financial crisis risk when Trump de-escalated a little bit on the rest of the world. I think the one caveat to that is that 10-year. We need to make sure that that's well behaved. If it really is a story of unwinding leveraged trades and that's the end of it, then that should run its course and we should get to a stable bond market. If there's something else that's going on, then we may need Fed intervention, but we're not there yet.
Do you think it's one or the other at this point? And what are you looking for that gives you a strong indication of that?
I think it's a lot of little things, if you will, on a treasury market that's not as liquid and more fragile than you think it is, right? So part of it is unwinding of basis trades. Part of it is meeting margin calls. I'm sure there was some foreign selling to kind of add on. I don't think that was the prime driver, but I think there was some add-on there. And so I think if you're looking for one big thing, you're not going to find it. It's a number of little things on a market that, quite frankly, needs some improvement. And I hope that when this episode's over, the Fed will take some steps to address liquidity in the Treasury market.
There are two aspects here. Yeah. On one hand, you have this question about the American safe haven status and this question of American exceptionalism. And on the flip side, you have this issue of whether Treasuries can rally into some sort of weakening outlook. And that is what we're expecting to see from the earnings coming in. How critical is it to see Treasuries rally on weaker data to give stock traders some confidence that we're not in a completely new regime?
Yeah, so you don't really worry. It's probably too strong a word, but you don't really worry about moves in the equity market, right? I mean, the equity markets they're important. I'm certainly an equity person, but they generally don't have that reflexivity that bond markets do. They're not as critical to the financial plumbing. So when you see dysfunction in the Treasury market, that catches your attention. This idea, though, of a buyer's strike on U.S. assets, I don't buy it. I don't believe that we live in a world that buys U.S. assets or trades with the U.S. or buys U.S. debt because they like us or because it's kind, right? They do it because they run major trade deficits with it. They do it because there's no substitute to the U.S. consumer. U.S. exceptionalism isn't because we've been nice. It's because all of the Magnificent Seven are magnificently American, and we're the only major economy that still has population growth or working age population growth. So I don't think any of that went away. I think maybe there was some add-on foreign selling. I think what this really had to do with was unwinding of highly leveraged trades.
Given that, do you think it's time to go into some of these tech stocks that got completely beaten up at a time when you still have a tariff regime coming for them, as we heard over the weekend?
So that was our ad. At 5,400 on the initial drop, we added large cap growth stocks. If you play this out, right, I think we've taken off those bottom economic opportunities here with at least the pullback on the tariffs around the globe. As you go forward, we're probably past that point of peak uncertainty. I think last week was pretty uncertain. So I think we're probably going to be a little less uncertain than last week. You do have a tax bill coming out that's going to provide some pro-growth. Deregulation is still to come. I think you're going to have a tough earnings season here. But if you think about an economy that's dealing with uncertainty and a little bit of weakness, who in the world is better able to handle that than the very large, enormous cash flow generating tech stocks that are out there that make up that growth index? So that we do think is an area that's going to recover here.
This is an argument that Veda Subramaniam at Bank of America had with us going into the weekend. Do you think we're underestimating the ability of companies on the S&P 500 to adapt to this?
Yes. Let's keep in mind, within our lifetime and not that long of a history, we've seen companies navigate, the near collapse of the entire financial system, and then we turned off the entire economy with a light switch. The fact that we've instituted what amounts to a national sales tax is certainly important for earnings. It's certainly going to hurt earnings estimates, but the idea that these companies can't navigate that, I think, is ridiculous.
The numbers are still huge, though. This came from Paul Ashworth of Capital Economics over the weekend, who said the increase in the headline tariff rate on China specifically remains at 145%. But the effective increase once those exemptions are accounted for is now closer to 106. Still, 106% on Chinese goods.
Yeah, it's not the worst case scenario, but this isn't good in terms of what the previous trade expectation was. I love that you brought up the idea of companies adapting and adjusting, because essentially what we're seeing is sentiment dropping to the weakest levels that we've seen, both among companies as well as consumers, going back to all of those great depressions and recessions, et cetera. And yet there is this still sanguine outlook. And how do you pair those two, which seem like they're contradictory, the words versus the actions?
We haven't seen the hard data hit yet. And there's an anticipation that the hard data will catch down to some very, very weak soft data. How will you and the team navigate that in the weeks to come?
I think there's 2 points. One is the de-escalation around the globe. What was important about that was not that it lowered the overall tariff level, because it was paired with an increase in China. So the overall tariff level was higher. but it gave companies optionality. In the old regime, before the de-escalation around the globe, there was nowhere to go or hide. Now you can. If you need to leave China, you can go to Vietnam potentially once we have a deal. I think the second thing in terms of the hard data, it's going to soften. I think you started to see a preview of that with the CPI and the PPI data next week. And so it would not surprise us, despite having a constructive outlook here, for us to retest the lows on the idea that over the next couple of weeks and maybe months, you're likely to see employment data soften, you're likely to see some of the inflation data, and I think earnings data is going to soften as well. I think that will then provide the basis for your next move up once you've kind of cleared the deck through that economic softness.
You haven't changed your allocation through all of this.
Yeah.
Everybody else sitting there like, oh, go to cash. This is awful. You've sat there. You've said, no, we're going to be modestly overweight stocks. What would make you rethink that?
What would make me rethink that, if we started seeing less Besant and more Navarro again, I think that would certainly be one. I mean, I think that certainly had a calming influence. So, you know, this idea that you've gotten past peak uncertainty is one. You know, two, if we were surprised by the downgrade in earnings, you know, we expect earnings are going to come down, you know, somewhere in the neighborhood of probably 5 to 10%. You know, anything outside of that. But again, what I step back to is this, and we were talking about this before we went on the air. The moment you accept a fee, you're no longer allowed to be afraid, right? That's what we provide for that fee, is to be clear-headed about it. And what you have here is a tax with other offsetting tax cuts potentially coming and deregulation, and companies that have proven that they can navigate this over time. And we don't think that that changes the long-term outlook for the earnings power of these companies. They will adjust around this.
Level-headed. Steve, it's good to see you, as always. Steve Chiavarone there of Federated Hermes. I've got some more good news for Steve. A little bit later on, you'll see more of Secretary Scott Bessent, the Treasury Secretary, sitting down with Annmarie in Argentina. They will be speaking at 4 p.m. Eastern Time, so don't miss that conversation a little bit later. Equity futures on the S&P 500 here up by 1.2% with an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. President Donald Trump pledged that he will still apply tariffs to phones, computers, and popular consumer electronics. The comments downplayed a weekend exemption as a procedural step in his overall push to remake U.S. trade. The president told reporters aboard Air Force One that his decision will come soon. Goldman Sachs and UBS see more upside for gold. In their most recent calls, UBS sees $3,500 an ounce by year end. For Goldman Sachs, it's $4,000 an ounce by mid-2026. The strategists both cited strong central bank demand and gold's role as a hedge against recession and geopolitical risk. And in sports, Rory McIlroy has added the long, elusive green jacket to his resume with a win at the Masters. McIlroy ended a decade-long major drought in dramatic fashion, recovering from 2 double bogeys to reach a playoff round against Justin Rose. McIlroy then hit a stunning drive to set up birdie on the 18th hole, beating Rose by just 1 stroke. The win marks his 5th major title. He's now the 6th ever player to achieve a career Grand Slam. And that's your brief, John.
Danny, thank you. A massive congratulations to Rory McIlroy and the team. CBS and Jim Nantz doing a phenomenal job through those 4 days. Jim Nantz put it best. Rory has his masterpiece. If you can take 2 things away from the weekend, the resilience of Rory McIlroy, the grace of Justin Rose. Just absolutely wonderful to see yesterday evening.
I was impressed that you came in last night because I expected you to be watching this game, and I know that you sacrificed, but it came out for you. So I just want to offer you congratulations for a well-waited-for victory.
I raced to the car and watched the playoff.
I imagine that was the case.
I wish it hadn't gone to a playoff, but I raced to the car to
so you got
watch
to
the
watch
playoff.
it, so it's a good thing.
Just congratulations, Rory McIlroy. Just absolutely phenomenal. Up next on the programme, the president attempting to keep the pressure on.
The tariffs will be in place in the not distant future, like we did with steel, like we did with automobiles, like we did with aluminum, which are now fully on. We'll be doing that with semiconductors, with chips, and numerous other things.
Up next on the programme, Ed Mills of Raymond James, live from New York City this morning. Good morning. Stuart Kaiser of Citi called in last week the least enjoyable 5% move on the S&P in recent memory. Equity futures add some weight to that rally, up by more than 1% on the S&P 500. On the Nasdaq, up by 1.4. Last week, the Nasdaq 100 up by 7.4 3%. Just amazing to see. Under surveillance this morning, the president attempting to keep the pressure on.
The tariffs will be in place in the not distant future because, as you know, like we did with steel, like we did with automobiles, like we did with aluminum, which are now fully on, we'll be doing that with semiconductors, with chips, and numerous other things. And that'll take place in the very near future. I'm going to be announcing it over the next week.
So here's the latest this morning. President Trump indicating exemptions on electronics announced over the weekend will be short-lived and stressing, quote, nobody is getting off the hook. Bloomberg's Tyler Kendall back with us this morning. Tyler, good morning. Put it all together for us then. Just where are we and what are we expecting to be announced in the next week or so?
Yeah, hey, John, good morning. So it's unclear how long this temporary reprieve will last because it does appear that these tech imports will be subject to a Section 232 investigation, which could take weeks or even months. And we have to keep in mind that when President Trump signed that original executive order on April 2nd, it always excluded chips as well as those other key industries that you just heard him mention there, including pharmaceuticals, copper, lumber, these sectors that could be subject to separate tariffs on the basis of national security concerns. And it now appears that those tech imports, including those consumer electronics, will be subject to these sector-specific tariffs instead of the so-called reciprocal tariff plan. As President Trump said, they're just moving from one bucket to another bucket. But when it comes to this Section 232 tariffs, when the White House has imposed them before, including on steel and aluminum, also auto imports, they've gone into effect at a 25% rate. President Trump declined to say if that would be the rate, but it likely will be around there, or at least lower than what we've seen they could have faced under, for example, the 145% tariff now facing Chinese imports. But still considered to be pretty punitive nonetheless, especially when you think that how these sector-specific tariffs are designed to be stacked on top of other levies. Now, John, importantly, this temporary reprieve applies to about $390 billion worth of U.S. imports. About a quarter of those come from China. So as these companies really look at their supply chains that are concentrated in China, they're going to be lobbying this administration for any sort of carve-out. It's something that President Trump did signal a willingness to engage with these companies on, saying that he wants to be flexible. It just remains to be seen just how flexible he really will be.
Tyler Kendall with the update down in Washington, D.C. Tyler, thank you. Lisa, how flexible will the president be? Some encouragement, I think, going into the weekend, coming out the other side, a little bit of confusion.
I think confusion is the right word. I mean, you have Howard Lutnick coming out and saying that ultimately they want a sphere, some kind of set of regulations around semiconductors to bring jobs back. You had the same message from Jameson Greer. Then you had the agricultural secretary coming out and saying, I do believe this will be a short-term negotiation period, and then we'll move into, again, the economy opening up. Pick your poison.
Joining us now to discuss is Ed Mills of Raymond James. Ed, welcome to the programme, sir. The take on Wall Street is that we're witnessing a bit of a policy pivot from the administration away from the markets. Your focus right now, what are you telling clients? You seeing that pivot or not?
Not yet. I do think that there is an old saying here in D.C. that things are never as bad as you fear, nor as good as you hope. We got maybe as good as you hope on Friday night with those exclusions, and only to kind of be reminded that there's going to be tariffs on semiconductors and, quote, other things that are coming in the Section 232 investigations. What I've told folks at Raymond James is that there's three buckets. Number one, kind of that global tariff that's getting revenue for these tax cuts. Number two, it's national security, which is what we're talking about here. And number three, those reciprocal tariffs really are about trying to get other countries to change their policies. So moving some of the semiconductors and other electronics from that policy change over to the national security is a relief from the 145% in China. But I have to remind folks at Raymond James is that those national security tariffs are probably going to be stickier, and it's going to be very hard to negotiate those away, John.
So where does a fentanyl bucket go into the national security, as well as the trade rejiggering, as well as the revenue buckets?
Yeah, I put the fentanyl bucket into that bucket 3 policy change, because if Mexico, China, Canada is included, never really understood why. If they're able to make policy changes in each of those countries, Donald Trump says those go away. I think the fentanyl for Canada, Mexico is really about trying to move forward the USMCA negotiation. Again, a policy-related change that Donald Trump is seeking, Lisa.
There are a lot of people who are on board with a lot of these goals. In fact, there are bipartisan support pretty much across the board, particularly for national security. Larger questions about how it's being rolled out and whether we actually know what the given tariff rate is at any given time. Ed, do you have a sense of what the actual tariff rate is, whether it's on China or whether it's on Europe?
I have what the executive orders and what the U.S. Customs and Border Patrol tells me. But when I talk to companies here at Raymond James, they tell me they don't know how to plan for this, that if they move kind of production from one country to another, is that tariff rate going to stick a week from now, a month from now, a year from now? And so, well, there is some relief. If companies don't know what their tariff rate is anytime into the future, they just hold steady. They don't make changes. And another thing that I've heard from a number of companies is that if they move production to the United States, because of the costs of goods sold, these raw materials are actually going to have higher tariff rates than the finished goods in a number of instances, is actually a hindrance to getting things moved to the United States at this point.
Ed, we started the conversation this morning with an investor who at the moment is still bullish and overweight US equities. Lisa asked him what it would take him to become bearish, and he said more Navarro and less Besson. From your standpoint, how important is the personnel issue at the moment, and how have things changed over the past few weeks?
Yeah, we've told folks at Raymond James here that there's two teams, Team Econ, Team Tariff. It was very clear that Team Tariff was driving the bus for the last month. In the last week, it's gone more to Team Econ. That's a good policy shift from my perspective. The problem that I continue to have is even though it's over at Team Econ, we still have 145% tariff on about 75+% of goods coming out of China. We have a global tariff of 10%. We have tariffs coming on semiconductors and, quote, other things, pharmaceuticals. Jameson Greer yesterday said a lot of those investigations might actually already be ongoing. And so, yes, I get a little bit of comfort moving over to Team Besant and Team Econ, but the tariffs that are in place right now are much higher than anyone would have anticipated. And if Donald Trump just started with this, it would have been freak out. It's just because he's moved the goalpost so far that it seems like relief when it's only 25% or it's only 125%, depending on which country you're talking about.
As we have these two camps that are battling it out in terms of the cabinet of Donald Trump, how much are your companies that you talk to worried about a diminishing of the American brand? And I say this at a time where the dollar is weakening yet again. This could be a positive for companies. It could increase potentially their exports. It also could be a negative if you see something that we've seen with respect to Tesla sales overseas percolate into other industries. How much does that come up with you?
It hasn't come up as much as I would expect. I think there is more of a question about what is Donald Trump's endgame. And one of the things that we've noticed in the market and noticed in conversations here at Raymond James is that the more that Donald Trump seems to double down, the more investors think this is an unsustainable path forward and ask me a lot more questions about how does the courts end this? How does Congress step in and end this? So it is a risk, and there certainly could be some diminishment. But the more that is pursued, the more that people are looking for escape valves. And I think there's a really good court case, or there's a real political pressure that gets on Congress if this does go too far.
Ed Mills of Raymond James. I'd appreciate your time, sir. Thank you. Just yesterday, we caught up with Libby Cantrell of PIMCO. Libby Cantrell said almost exactly the same thing about the release valve that could be used down in Washington, D.C.
She said the big news over the weekend was that the exemptions that were announced on Friday essentially made this president more vulnerable to using IEEPA, the Emergency Powers Act, to enact some of these tariffs, the 145% tariffs on China. So it actually undermined and weakened their case to really be able to execute this. If it is an emergency national security issue, why do they have to give an exemption to 20% of all of the exports coming into the country?
It's a good point. It's a question she asked as well. Equity futures this morning positive still. We'll see if this holds. We're just about holding right now, up by a little more than 1% on the S&P 500. Up next on the programme, Nela Richardson of ADP as tariffs weigh on consumer sentiment. You, Mitch, was ugly, ugly, ugly going into the weekend. We'll break down that economic data in just a moment. Last week, posting the best week of the year so far on the S&P 500. Equity futures add to that, up by 1.2% on the S&P. On the Nasdaq 100 this morning, up by 1.4, with 3 hours until the opening bell. Let's get you some morning movers with Danny Berger. Hey, Danny.
Hey, John. Apple leading the gains amid that tech outperformance with the exemption for electronics from tariffs, as temporary as that might seem to be. So Apple up just under 5% this morning. But keep in mind, this thing is down more than 20% from its peak. So a lot of bad news already priced in. KeyBank raising its call on tech, saying that the actions from the administration over the weekend remove a key risk. But I don't think a lot of people would agree with this. They are not out of the woods yet. Intel also rallying with the rest of tech, but getting an extra boost this morning from Bloomberg sources telling us that they're going to be selling the programmable chips unit to the PE firm Silver Lake. Those shares up 4.5%. Sources say, though, that the deal is not final and it could still get derailed. And we have certainly seen a lot of deals get derailed because of market volatility. Finally, just rounding things out with a check on where Goldman Sachs stands this morning. It is higher in the pre-market session, 2%. We're going to get earnings from them in about an hour's time at 7:30 a.m. Eastern. We had strong results from their peers, especially when it came to equity trading. So that's the bar for Goldman Sachs. John.
Danny, thank you. Decent numbers from both Morgan Stanley and JP Morgan going into the weekend. On our radar this morning, President Donald Trump pledging to apply tariffs to chips, phones, computers and other consumer electronics, writing, quote, "Nobody is getting off the hook." His comments coming after he announced a tech tariff pause over the weekend.
So clear as mud. And this is basically what everyone's talking about, the fact that we're not necessarily getting a sense of exactly what the path is going forward. A key question to me is, how do you escalate? And you raised this question yesterday. Is this sort of peak escalation, given the fact that China is saying, look, at this point, it's silly. This is a joke. You raise it back beyond 445%. We're basically just making up numbers here. Can it get worse? What about the rare earths metals? What about some of the other exports? What is the leverage that each side has at a time where both economies are still intricately connected to one another?
I think on the margin, to your point, there are other things they can do. It can get worse. I think the focus, though, will shift to other things, and it's the economic data. The damage done to the soft data is real. It's been building now for a number of months. And there are some people who believe that the damage to the hard data is unavoidable at this point. And my focus is certainly shifting to try and understand what that's going to look like in the next few months.
You saw that this morning with Morgan Stanley, among others, coming out and downgrading their expectations for EPS as we come into this earnings season. That is the first data you're going to see it in. That is going to be the hard data. The companies talking about near-term disruptions in demand. We saw that from Delta. If you read through their earnings transcript, they talk about how domestic travel has really taken a hit, how you're not seeing that kind of filling up. And I have to say, I took a plane recently, and I was shocked at how empty it was. Anecdotally, these planes used to be packed to the gills, and now you're actually getting upgrades. I mean, it's a very strange moment.
I've heard the same thing. We'll hear from United a little bit later on. Good for you getting the upgrades, though. Let's get to the data from China. China's exports rebounding in March with near record shipments flowing to Southeast Asia. The Customs Authority saying exports rose 12.4% from a year earlier, reversing a 3% decline in the month of February. Lisa, you made the point out on X earlier on this morning, I think. It's important to look at exports, sure, but imports tell you a story as well in China, and it's not a great one.
So Brad Setzer, who used to work at the Treasury Department and is really a brilliant analyst in terms of trade dynamics, put out a series of charts saying that China's trade surplus has skyrocketed over the past few quarters and has not just been with the United States. It's pretty much tracked with the EU as well. So people who say this is all due to companies front-loading imports from China to get ahead of tariffs, that's not the whole story. It's also that China is not importing anything from anyone. This could be one of two things. One, a focus on nationalism and focus on their national brands. And two, and this is a key one, the economy still isn't recovering. How do you juice demand at a time where it's still flat on its back? And that is a big piece of this story as well.
The Treasury Secretary pushing aggressively for China to rebalance their economy, and no real signs of that happening just yet. We're going to see a bunch of negotiations take place over the next month or so. Japan's Prime Minister saying he won't rush to compromise with the US in high-stakes trade negotiations this week. Local media reporting the country's economic revitalization minister will be heading to Washington on Wednesday.
So a couple of things here. First of all, over the weekend, we did hear from one of the leaders in Japan saying that they were not going to use U.S. treasuries and selling U.S. treasuries as a negotiating tool. So people who are suspecting that Japan was behind the turmoil, you can back off. That's basically what they were saying with number one. Number two, what's interesting is they have somehow gotten a hearing with Scott Bessent, which a lot of people think is a very positive sign in terms of their ability to get some sort of exemption. I love that people are using Besant versus Navarro as the litmus test of whether things are making progress or not, but here we are.
We're baking down trading to risk on, risk off based on whether you see Navarro or Besant. Is that
I
how
think
this works now?
Pretty much we're going to have a tally where it's, Besant appearances, risk on, Navarro.
It's risk on right now, for equities at least. Equity futures positive by more than 1% on the S&P. If you are just joining us, if you're looking for stability in the bond market, you've got it at the moment. We're down across the board here, across the curve. We're down 6 or 7 basis points at the front end on a 10-year maturity. The yield is down 6 to, let's call it 4.43. Let's turn to the economy. US consumer sentiment falling to its second weakest reading on record, while inflation expectations soar to multi-decade highs. Nela Richardson of ADP writing, inflation has made consumers cautious, but rising incomes can help cushion any tariff-driven price increases if they come. Nela joins us now for more. Nela, good morning.
Good morning.
Let's just focus on the data and get away from the politics. Are incomes still rising?
You know, we're seeing that when we look at payroll at ADP, they're certainly rising, not as fast as they were 2 years ago, but at a healthy clip, faster than before the pandemic. There's also a different source of income that's really important to think about, which is the housing market. We get housing starts later this week. Home equity for homeowners is up almost 9% from a year ago. So, no, it's not the highest home equity we've seen on record, but it's close. It's like the third highest. And so that's another level of cushion. I don't mean to be too Pollyanna on a Monday, but I also want to give a real data reality check to all the uncertainty that's out there in the market.
I was just going to say, you're not complying with the narrative. I love it. I think it's great. And I think it's good to push back against it because there's so much gloom and doom about companies who are frozen, who aren't going to be hiring. They're not going to be firing, but job mobility just isn't there. You're still seeing just some signs that consumers are maintaining resilience through other means, even with the stock market that maybe rallied last week, but certainly didn't feel like it, and even with the idea that it might be harder to get a raise.
You know, I don't discount the sentiment because sentiment usually triggers certain behaviors. And you see downbeat sentiment with consumers, with home builders, with CEOs. Everywhere you go, there is a pessimism in the outlook. But then when you turn to the raw data, this week is super important. Why? This is the reference week. This is the week that the BLS will start counting the number of people who got paid for for their employment report. And this is the week that ADP will report in 2 weeks to talk about the labor market. And if you look at this week and you compare it to March, what you're seeing is that hiring is still solid. And if you look at one area of sentiment that is holding up, worker sentiment, we're actually going to produce a worker sentiment index tomorrow, publish it at adpresearch.com. What you'll see is that while consumers are downbeat, workers are highly engaged. They're plugged in. Maybe it's because they're cautious about their job loss, but they're showing up, they are engaged, and they are productive, and they're doing so because they want to make sure that they keep those jobs as they move into the rest of the year.
So quiet quitting has died, basically, is what you're saying, which is actually
we're seeing less
really welcome.
Of it.
That's fantastic.
We're seeing less of it.
I'm curious. You say that hiring is remaining solid. Mm-hmm. Is it in specific industries that give you a sense of potentially whether this is a resilience factor or whether this is people getting old and needing to cater to them of getting factor?
Yeah, that's a great question because we really do see a good news, bad news scenario there. We're seeing hiring across firm sizes. That's good news, especially if you look at small businesses who are price takers in the global input market. We're seeing solid hiring across the board, but not every industry. In fact, if you look at consumer-facing industries, they're somewhat discretionary, like leisure and hospitality. It's been weaker. If you look at retail, also weaker. So we're seeing hiring in, ironically, manufacturing. So we don't know if that's pull forward hiring to get ahead of some of these tariff and trade changes, or if this is a real rebound. And we're seeing it in B2B services, but not so much in consumer-facing industries. That is a sea change, and it's tied directly to consumers and how they're feeling about the economy.
You talked about the importance of expectations. Let's talk about how consumers are feeling about this economy. You met Chad on Friday. Consumer sentiment, almost 3-year low. Inflation expectations, multi-decade highs. Unemployment expectations, the worst since 2009. Are you seeing anything in the hard data to validate consumer confidence that weak, that poor, that we saw on Friday?
On the labor market, no. Layoffs are at, a 2-year low. They continue to hover around those 2-year lows in the private sector. different for the federal government. But in the private sector, we are not seeing that kind of upturn and upheaval and pause in hiring that is being projected or picked up in the sentiment. Now, things can change rapidly. I'm not saying that the outlook that we're seeing right now is going to be consistent 6 months from now. But if you're looking at the starting point and the baseline, you're seeing, and I think Chair Powell said this in his recent remarks, a labor market that is solid and continues to perform.
Still this massive spread, Lisa, between the soft and hard data. I keep going back to that headline from you, Mitch. To see unemployment expectations down at the worst levels we've seen since 2009 is pretty staggering.
It was funny. You were mentioned that in the past couple of weeks. Lori Calvasina put that out in a report saying that in all of the earnings calls, also corporate executives have been talking about how this reminds them of 2008. This reminds them of 2020. This reminds them before that of the 2000s. You see that in the AAII sentiment survey as well. So at a certain point, have we really reached a new paradigm shift, though, where suddenly the soft data has not been predictive of the hard data? Or are we going back to something more normal, where you would normally see a correlation there?
So the Federal Reserve's not blinking, and neither the Federal Reserve will be meeting in early May. That meeting concludes. We'll get that decision on May 7th. What do you make of how they've navigated things so far, and what would you expect to see in a few weeks' time?
I think the Fed has navigated the way Main Street has. They're waiting and watching. There hasn't been any big money moves that we can identify. And I think it's too early on the policy front to make any firm movements. And that's what you're seeing from the Fed. But it's also what you're seeing from small businesses and medium-sized businesses who can't change operations on a dime. Consumers can't change spending patterns on a dime. So what you're seeing is an economy that started from a solid baseline in wait-and-see mode, just like the Fed.
You know, there was this discussion that we had, and it was off air, about whether this Fed is going to be really just targeting dysfunction in the Treasury market or whether they actually were going to be looking at levels. We're not going to close the spreads until the spreads get too wide, and then we're going to close them akin to maybe what the ECB has been doing. I am curious about this theory that Neel Kashkari put out over the weekend, saying that we at the Fed have zero ability to affect that destination of 10-year yields as investors try to get some sort of price discovery here. Do you believe that, or do you think that there is a level at which they do step in?
Well, I think this comes to your sentiment momentum distinction. I mean, the Fed operates at the short end of the curve. That is their mandate. And so I think if you take the literal interpretation of the Fed's actions, yes, they're not responsible for the longer end of the curve. But we know that the Fed has a huge sentiment role in all of this in itself. And just by their forward guidance, they can change the way the bond market reacts. So yes and no, hard and soft. We're still back in that distinction.
So I guess to sum it all up, do you see the unemployment rate rising quickly enough to get the Fed engaged in terms of cutting rates or having some sort of stimulative effort in the near term, in the next 2 weeks, the next 3 weeks, before, or the next 2 months, right before the economy really can turn?
Not in the next month, no. We have not seen the transmission mechanism multiply to an effect that it hits the real economy in a way that you would see the kind of staggering job loss that would justify on its own a rate move by the Fed. The labor market is still holding up. 209,000 private sector jobs created, according to the federal government last month. That's not going to be a downbeat measure by anyone's estimation.
Nela, it's good to see you. As always, thanks for dropping by. Nela Richardson there of ADP. Step one of the Federal Reserve is to pledge to anchor inflation expectations. Step two, they've basically told us if unemployment breaks, to Nela's point, they're going to step in. We saw that last summer. At the moment, that's not breaking at all.
And it's unlikely that it's going to break, at least in the near term, even as people ratchet down their recession calls. At the same time, they also have this off-ramp of dysfunction. Define dysfunction. Good luck. Have a good time. Say that it's necessarily some sort of failed trades. That's not happening. Say it reaches 5%. Well, they're not saying that, but, you know, things change when sentiment changes.
Is anyone having a good time at the moment? I'm not sure they had a good time last week, even with that 5 to 6% move in the equity market.
So to me, the idea that Jim Reed and Henry Allen at Deutsche Bank put out was really telling. That financial markets experienced one of their most tumultuous periods in living memory. That last week, we saw the biggest sell-off since 2020. We saw the biggest rally since 2008. We saw the biggest weekly surge in 10-year Treasury yields going back to 2001, and the biggest surge in 30-year yields going back to 1987. Are you having fun yet?
It was that FX bond mix that got a lot of people concerned, right? That 50 basis point move we saw on a 10-year yield higher, together with the weakness we saw in the FX market, dollar weaker. This morning, if you want an update, the dollar weakness continues, but in the bond market, some stability. The 2-year yield is down by 6 basis points. The 10-year is down by 6. Your 10-year at about 443. With an update on stories elsewhere this morning, let's get to your Bloomberg brief with Danny Berger. Hey, Danny.
Hey, John. Police have arrested and charged a 38-year-old man after an attack on the Pennsylvania governor's mansion, where Governor Josh Shapiro and his family live. Suspect Cody Balmer turned himself in and faces charges including arson, attempted murder, and terrorism. Shapiro and his family were evacuated early Sunday morning and are unharmed. Elsewhere, Meta faces a landmark antitrust trial today. The FTC alleges that the tech giant acquired Instagram and WhatsApp to eliminate competition and maintain a monopoly. Meta says the acquisitions were approved by regulators over a decade ago. And Dubai topped Heathrow as the world's busiest international airport, that from the Airports Council International. The Gulf Airport handled 92 million travelers last year, up 6% compared with 2023. Heathrow, in second place, handled about 79 million passengers. And that's your brief, John.
Danny, thank you. More from Danny later on in the program. Up next, a shakeout in the bond market.
From our perspective, we're seeing a complete deleveraging of positions, whether it's been swap spread trades, whether it's been the Treasury basis, all those things have begun to unwind, and it's put a lot of downward pressure on Treasury prices.
That conversation just around the corner, live from New York City this morning. Good morning to you all. You're watching Bloomberg TV. From New York City, welcome to the program. Equity futures still positive here, holding on to gains, up by 1.3%. The bigger gains coming from big tech on that tariff exemption, if we can call it that. The president's saying we can't, but ultimately that's what it looks like. Up by 1.5% on the Nasdaq 100 this morning. Under surveillance this morning, a big shakeout in the bond market.
From our perspective, we're seeing a complete deleveraging of positions, whether it's been swap spread trades, whether it's been the Treasury basis, whether it's been investors who sold Germany and bought the U.S., all those things have begun to unwind, and it's put a lot of downward pressure on Treasury prices. It's a one-time price reset for tariffs that will create demand destruction and lead us to recession.
So here's the latest this morning. U.S. Treasuries looking to rebound after posting their biggest weekly loss in some 2 decades. Evercore's Krishna Guha writing the following. There are only 4 other episodes in the last 30 years in which the dollar appreciated, or rather depreciated, more than 1.5%, with the 30-year bond yield at more than 10 basis points. Krishna joins us now for more. And Krishna, we saw that last week. I'd love your view on this situation. How concerned were you at times seeing that kind of price action through last week?
Yeah, very concerned, to be honest. This kind of behavior, yields higher, currency lower, is what you see all the time in emerging markets that come under pressure. It's what you saw in the UK during the Liz Truss debacle. We do not see this kind of behavior in US markets, other than in exceptional times. The one period in the last 30 years where you saw some price action of this kind was shortly after Lehman failed. So this is absolutely not business as usual. And when you see this combination, essentially what it's telling you is global investors are taking money out of the US and reallocating it to foreign markets. That's the only way you get the combination of yields up and currency down. Now, as you say, maybe the market's going to try to consolidate some today, but we need to keep a very close eye on this going forward.
Krishna, how do you determine whether this is a sell America moment versus some sort of leverage trade unwind, which is what a lot of people have been saying?
So I think it's clearly a bit of both, right? And part of the risk right now lies in the scope for interaction between global portfolio reallocation, slightly smaller allocation to the US, increased allocation to other markets, in particular Europe, but not only Europe, Japan, some other places, and the ongoing delevering, degrossing in the hedge fund community around basis swap spreads and so forth, which have so far proceeded relatively orderly. But when these two forces are operating at the same time, there is some additional risk, of course, that this could start to get out of hand, and that's why the Fed certainly would want to keep a close eye on this. Just very quickly, how can I tell you with very high confidence that it's not all leveraged trade unwinds? Well, if it was, it would be yields higher, but it wouldn't be dollar lower. The dollar lower piece has to have a cross-border aspect to it.
There is a cross-border aspect to this question of how much people had overweighted the American exceptionalism story.
Yes.
And this idea that suddenly people are pulling back. And there is this argument being made that it was strange that the dollar was as strong as it was based on the fact that the Fed had cut by 100 basis points and that typically you would see a dollar weakness at that point. But that didn't happen because of this belief in American exceptionalism. At what point can you say this is actually healthy? This actually balances some of the imbalances that came from an overly strong dollar.
Well, again, some dollar moderation in and of itself could be constructive, could help, in terms of the process of rebalancing the U.S. economy and so forth. But dollar depreciation that comes along with rising yields, that is not good news for anything, particularly not for a country that runs a very large structural deficit that might be about to go into a recession, that is considering tax legislation that's likely to increase rather than decrease the deficit, and with some risk that if things get bad enough in terms of the economy and unemployment, that the current administration and its allies in Congress could be tempted to go for broke with still bigger tax cuts. The tricky thing here that it's really important to understand is, what is a trade deficit? A trade deficit is a capital surplus. And the actions of the U.S. administration in seeking to draw back from international economic engagement, to threaten its creditors with Mar-a-Lago Accords, user fees, this kind of nonsense, runs the risk that the foreign investors who are a core part of the U.S. Treasury market may have reduced appetite to purchase this debt at precisely the time when there's upside risks to deficits. So it's not that dollar moderation is a problem. It's that we need to think through the interaction of what's going on in the dollar and what's going on in the bond market. In effect, what's going on in the trade account and what's going on in the capital flows.
Begs the question, Krishna, does the Fed actually have a role to play here or not?
Well, the Fed has potentially, of course, two different types of roles. One is to intervene in the Treasury market or adjacent markets like the repo market in the event that there is severe stress on market functioning. That's not linked directly to the level of prices or the level of yields. It's about market functioning, though, of course, when market functioning breaks down, prices can overshoot. So the two are not perfectly separated. Right now, market functioning is okay. It's hung in there. It's not great because there's, sort of long one-way traffic, but it's held in okay. And so the Fed on that basis will, I think, continue to hold fire, will only intervene for market functioning purposes if there's a more severe deterioration in market functioning, which could come at any point, but isn't there now.
Krishna.
Separately, of course, the Fed has to deal with the macro impact of all of this.
They've got a lot of work to do potentially on May 7th. And May 7th feels like a lifetime away. It's good to see you, sir. As always, thanks for breaking that down. Join us again soon. Krishna Guha there of Evercore. That's Evercore's view. Deutsche Bank, very direct. George Saravelos over the weekend. If recent disruption in the US Treasury market continues, we see no other option for the Fed but to step in with emergency purchases of treasuries.
Well, we heard the same thing from Bob Michael. At a certain point, they have to step in. At what point that is, they'll feel it out.
Up next on the programme, Peter Tchir of Academy Securities, Henrietta Treyz of Veda Partners, Gerard Cassidy of RBC with Goldman earnings just around the corner, and Vivek Arya of Bank of America from New York City. This is Bloomberg.
There's greater uncertainty around the U.S. Uncertainty doesn't do it justice.
That max uncertainty that we all keep hoping to get behind just continues on a daily basis.
The market does want to know that there is some put from policymakers.
You're completely switching around the world order of the last 40 years.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning to you all. The second hour of Bloomberg Surveillance starts right now, and your price action looks like this. Equity futures gaining by 1.4% on the S&P 500. Some outperformance on the Nasdaq. A relief about exemptions for the likes of Apple and Nvidia. Apparently that relief will be short-lived. Stay tuned for an explanation of that in just a moment. Some good news in the bond market. A lot of you spooked by the moves of last week. This morning, yields are lower by 5 basis points on a 10-year, 443 on 30s. We're down a basis point or two. This hour, we'll hear more from corporate America. Goldman earnings just around the corner, 30 minutes away. As we work our way through the week, you'll get more economic data and earnings. And Chairman Powell's on the calendar. Chairman Powell speaking this coming Wednesday.
Which potentially could be the main event. The big question for him is, how does he respond to what a lot of people are saying isn't quite dysfunction, but is feeling a little bit like dysfunction? And given the fact that people have typically seen the Fed step in at times of great uncertainty, given the fact that people are drawing analogies to 2008 and 2020, you would expect them to do the same. So far, the answer is not our problem. You deal with it, because right now there is no dysfunction. Ultimately, the other big event to me is going to be earnings and how corporates really guide ahead.
More from Goldman in about 29 minutes' time. Let's sit on that market move. I think it's important. So last week we had a 50 basis point move higher on a 10-year yield. And at the same time, we had a weaker dollar, not a stronger one. The dollar weakening by almost 3%. That spooked people. And they're looking at two options here, Lisa. Either it was a big unwind of trades and a risk aversion period, a big bout of risk aversion, or you're starting to see some leakage as people step away and question the safe haven status of the United States.
And we've heard conflicting things from different people. Some people, like Bob Michael, attributing it much more to some sort of leveraged trade unwind. Jordan Rochester said, regardless of what it is, Trump seeing a watering down of tariffs, but still dollar weakness and U.S. rates still selling off. They were at least late last night in the futures market. He said it's a horrible, toxic combination. And right now, the fact that the dollar is still weakening gives you a sense that maybe something else is still at play, especially given that this rally, certainly in the 30-year, doesn't scream some sort of rebound after the worst weekly sell-off since 1987.
That dollar weakness continues. DXY down by 0.6%. The euro stronger against the weaker dollar. That currency pair 113.86. Coming up this hour, we'll catch up with Peter Tchir of Securities as investors brace for more volatility. Henrietta, Treyz of Veda partners on this weekend's policy confusion, and Gerard Cassidy of RBC reacting to earnings from Goldman Sachs. We begin this hour with stocks higher, looking to build on their best week since 2023. Peter Tchir of Securities writing, for the first time in weeks, I'm optimistic about the outlook for the economy and for markets, but it is tempered slightly by all the measures it took to get here. Pete joins us now for more. Pete, good morning.
Morning.
Where's the encouragement come from?
Well, first I wrote that like at 9 a.m. on Sunday, so I'm probably not quite as encouraged as I was. For me, what I would really like to see is a true pivot towards domestic growth, right? Let's get the CHIPS Act money out there. You know, last Thursday at the cabinet meeting, a couple of the people talked about shipbuilding. I think we have to spend some money, do some things domestic growth, long-term contracts, either with shipbuilders, something to, that we can really get our hands around and grow, build up manufacturing without necessarily having to fight with the rest of the world.
Do you think it's likely we'll see that?
I'm increasingly dubious. I did not like, all the mixed messaging we got on tariffs over the weekend, right? From Friday night, no exemptions to more exemptions. And I think I'm a little bit worried about bond yields as a whole. Partly, I do think foreigners should be selling. I think you can get better yield in your own country. There's all this talk about, potentially fees on foreign holdings, Mar-a-Lago Accord. But beyond that, if you just take away, I think we missed three things last week. The budget for the military, Trump wants to do $1 trillion instead of $800 billion. That's going to add to the budget. We just had very large debt ceiling raises. That gives them the opportunity. And finally, DOGE at the Thursday morning cabinet meeting basically said they're targeting $150 billion for this year instead of $1 trillion. And places like the Wall Street Journal things are reporting that they can't even come up with $150 billion. So we are not on the right track on the deficit, which I think was everyone's big hope. So I think bond yields lead us lower across the board right now until we do something domestic to help growth.
Bond yields lead us lower. Can you elaborate on that? And by the way, coming out and saying that you're optimistic and then this litany of negatives really is just,
Well, he did say he wrote it at 9 o'clock yesterday morning.
That's true, which gives you a
things
sense
change.
of just how quickly things are. So what do you
And I was very, very bearish. So I was thinking, we were heading towards 20% down from here. It feels like it might be more controlled. I will watch very closely today. When we went through the GFC and even the European debt crisis, one thing thing that always struck me as key when we moved to a new leg of the problem was you'd get the announcement you were hoping for, so in this case, tariff exemptions, and if you don't last a full day on the rally, it tends to mean the market's now looking through that and saying, okay, yeah, these exemptions, whatever, let's look what we actually have on the table, and it's a lot of problems out there. And the other part that makes me a little bit nervous that I think we'll see is if we stick to tariff deals, I think tariff deals are easy. I think we're going to have to go after trade deals. And to me, trade deals will require import quotas, something like that on behalf of these other countries, and possibly restrictions on what they can do with China. I don't think that's going to be that easy for them to digest. So I think we'll learn a lot more in the this week about deals. Tariff deals, I'm comfortable with. If it goes down trade deals, I think we take another leg lower.
You know, I've seen so many notes where people talk about how exhausted they are and how stressful this period is. And I was thinking about why. And there's this flood of information, and it's hard to understand what structure to even put them in. What have we learned versus just tidbits of information that are coming in at you in rapid fire? Have we learned anything from the turmoil of the past week? Are we past peak uncertainty and heading into something that we can more concretely hold?
So the biggest thing for me that I can't quite figure out, and I think is really critical, is did China get sucked into being more aggressive on tariffs? How we play this out? Did we make it look like it was the U.S. versus everyone? China was more aggressive and now regrets it? Or did we learn that China really doesn't care, that China spent 4 years preparing for this and is really ready for the fight? I lean towards the latter. I will give the people who talk about, art of the deal and 4D chess, that it could be the former. And if it's the former, that's great, because China will have to back off. If it was the latter, we're not really prepared for this at all.
I'm pleased you went there. Is there any sign that China's coming to the table? Do you see anything at all?
No, I think, we have to go back, and we're about 15% of China's exports. And, I think they exempted 25%, whether it lasts or not. But I think that's also looking at it on the raw dollar value. I think from a profit margin, we exempted probably China's most profitable things that they export to us. I don't see them coming to the table. I see the rest of the world talking to them. We've been and which is very dangerous. And again, if you're in that part of the world, you probably have to play nice with China. Their military is there, their navy is growing. It's unclear what direction Trump wants to go on some of that. And the rest of the world, I think, is very tired. The uncertainty doesn't do well. And everyone knows it's going to take years to rebuild manufacturing, which is why I go back to I'd be much more optimistic if we started doing things domestic. Maybe we buy $10 billion of Navy ships, but they have to be built in a U.S. shipyard. And that's going to be 10 years of delivery, but it can start that process.
We've talked a lot about the pressure that was put on Europe, and it's pushed Europe to do things that is good for Europe. And I just wonder if this pushes China to do things that is good for China, in line with what the president would actually like to see from China, which is a rebalance of the economy towards domestic consumption. Are you hopeful?
No, I just don't think Chinese consume the way we do. I think, quite frankly, no one consumes the way the U.S. does, right? We consume a lot, and that's another concern about the economy, right? We're seeing some delinquencies tick up with all this uncertainty. I think China is going to try and do what they do, trade with the rest of the world, trade with us, and we're going to figure out where they have the opportunities. Again, they've spent the last 10 years building up 90% of rare earths and critical minerals are refined in China. We can get them anywhere. I think that's not the hard part, whether it's cost justified to get it out of anywhere. It's the refining, and again, that's going to take years. So China's putting all this pressure on us. And again, this was ridiculous 5 years ago, when we talked about this at Academy Securities, the number of things that are really critical to military equipment that we were getting from China when we were having all this friction with China was insane. So bringing those back makes sense, but we've done it in such a way that I think we've left ourselves vulnerable in the meantime.
So it seems like we haven't really gotten much clarity when it comes to understanding the off-ramp between U.S. and China negotiations. We do have a sense, though, of what that off-ramp looks like for President Trump to cater to a market, specifically the Treasury market. And I want to go back to something that you said, which is that you think that the bond market is going to lead the rest of the markets lower from here. Have we learned something about where that Trump put is in terms of what kind of levels of bond yields get him nervous?
A little bit, but I think it was very easy with all the noise last week to talk about this as being foreign selling, this basis trade unwinding, right? So, the Fed said they would, encourage, they would protect the bond market, which I think they will. They'll buy some here or there. I don't think we're going QE, but I think it was very easy to think of this as a temporary thing. If the conversation starts turning, as I think it might, that our deficit isn't going away, Doge isn't being as successful as we wanted, we are not being spendthrift, I think that starts putting even domestic pressure on yields and people saying, well, maybe even with inflation coming down, we're not at the right level. So that, to me, would be a bigger problem, right? And it'd be hard then. So what can he do? I'm not sure at that point.
Okay, so if you get to like 475, If we get to 5?
I think they're
I'm trying to come up with structures.
I don't know. I think they're begging the Fed to support. And again, a lot of this happened overnight last time. If it starts happening more and more during the day, that's where I think the fear comes out. But I don't know what he can do other than go keeping flip-flopping on tariffs.
Yeah.
And it feels like they're kind of tired of flip-flopping on tariffs. And the other part is with this whole deficit, right? We were at one time, and it was always confusing how much of that was going to be the case, but tariffs were going to help reduce our deficit. Well, if that income's not really coming in, where are they going to get other income? And I think they're going to target foreign holders of treasuries. Again, there's talk about delisting some of the Chinese ADRs. I don't see what that really does at this point, but that probably triggers yet another response from China. And I just keep thinking that we expect China to make these simplified moves. And we've talked about this before. Xi has learned something. Trump 1.0, Xi was the first one to Mar-a-Lago. Every time Trump said tariffs, they raised their hand, trade delegation. They have played this very differently. So just like Trump administration has had 4 years to plan this, China has had 4 years to plan this, and it's beginning to look like China spent a lot more time and money planning this than the U.S. did.
It doesn't look like a negotiation right now. In fact, Lisa and I were talking about this yesterday. It looks like the U.S. is negotiating potentially with itself at the moment. You're not hearing much back from China. I wanted to finish on one final point with you, because you've been very consistent about this. As we work our way through earnings season, you've really, really raised the flag about the damage being done to the American brand. Not about the attractiveness of U.S. assets, but the attractiveness of U.S. goods, U.S. services. How much damage has actually been done?
I think we're going to see some of that. And this first wave is going to be a little bit difficult to tell whether it's just because of global economic weakness that foreign sales sell down, or you're going to have to start looking, is there an indication that, say, Cadbury, for example, starts doing better than some of our brands overseas? And that, I think, will be the real key. Try and figure out pairs where, okay, here's a European or other brand, and are their sales declining or changing relative to the U.S. brands? And I think that would be a big shock to the system, because I do think people believe, and you can see it in some of the price action today, that there's just this huge demand for our brands globally, and it's only being affected by tariffs. I think we've diminished that as part of this overall trading strategy, and that's going to be harmful. And I think we may even see some companies talk about it. I think it's too early this quarter, but as this goes on, I think that becomes an issue for the rest of the year.
Interesting. One to watch. Pete, it's good to see you. Thanks for dropping by. Peter Tchir there of Academy Securities. Equity futures at the moment near session highs by 1.5%, with an update on stories elsewhere. With your Bloomberg brief is Danny Berger. Hey, Danny.
Hey, John. A check on Pfizer shares lower by about 0.5% in the pre-market trade. In a major setback, it will stop developing its obesity pill. Pfizer said that in a clinical trial, there was a potentially drug-related liver injury in one patient. It leaves Pfizer far behind its competitors without an obesity treatment in the market. Elsewhere, Japan's prime minister said that the country is in no rush to compromise with U.S. trade negotiations. The country's chief trade negotiator is set to visit the U.S. Wednesday through Friday and will be discussing levies on cars, agricultural products, and FX with Treasury Secretary Scott Bessent. Citi equity strategists have lowered their view on U.S. equities to neutral from overweight, citing the trade war's impact on economic growth and earnings. The firm joining its Wall Street peers and lowering its year-end target for the S&P 500 to 5,800 from 6,500. And that's your brief. John.
Danny, thank you. More from Danny later on this hour. Up next on the program, a brief sigh of relief for big tech.
The tariffs will be in place in the not distant future, like we did with steel, like we did with automobiles, like we did with aluminum, which are now fully on. We'll be doing that with semiconductors, with chips, and numerous other things.
Up next on the program, we'll attempt to make some sense of the announcements from over the weekend. We'll do that with Henrietta Treyz of Veda Partners, live from New York City this morning. Good morning. Later on this afternoon, an exclusive conversation. Annmarie sitting down with the Treasury Secretary, Scott Bessent, live from Argentina at 4 p.m. Eastern Time in New York City. Do not miss that conversation coming up a little bit later on this afternoon. At the moment, equity futures are elevated and near session highs. We're up by 1.5%, call it 1.6 on the S&P. Apple is higher by more than 5%, exempted from so-called reciprocal tariffs, but we'll still get hit by tariffs eventually. Yes, really. We're going to make some sense of this now. Under surveillance this morning, a brief sigh of relief for big tech.
The tariffs will be in place in the not distant future, because as you know, like we did with steel, like we did with automobiles, like we did with aluminum, which are now fully on, we'll be doing that with semiconductors, with chips, and numerous other things. And that'll take place in the very near future. I'm going to be announcing it over the next week.
So here's the latest this morning. President Trump indicating exemptions on electronics will be short-lived and stressing, quote, nobody is getting off the hook. Bloomberg's Tyler Kendall joins us now for more. So, Tyler, help us out here. What was actually announced over the weekend and what will be announced in the weeks to come?
Yeah, hey, John. So it appears that these tech imports, including consumer electronics, will now be subject to a Section 232 investigation. That would then allow the White House to impose tariffs on the basis of national security concerns. So as you mentioned, these tech imports now under the sector-specific umbrella instead of the so-called reciprocal plan umbrella. We have to keep in mind that these Section 232 investigations typically take 270 days. That's roughly 9 months. But it appears very evident that this White House would like to see it done sooner. And they've already implemented an expedited timeline on other Section 232 tariffs, including for steel and aluminum imports as well as auto imports. We have to keep in mind also that how these tariffs are designed, it's to be stacked on top of existing levies. And President Trump made clear that all of these tech imports are still subject to that 20% baseline tariff that's been imposed on Beijing since February. But still, no matter how fleeting the reprieve, it is still widely considered to be at least an initial victory for these big tech companies as they try to seek some more permanent carve-outs from the administration. President Trump said yesterday that he was open to having some flexibility when it comes to specific products. But of course, the scope and the timeline here is just still so uncertain. And John, I would just mention very quickly that we should also be watching how this White House messages around critical minerals that go into semiconductor chips and the supply chain in the days to come as Beijing moves to restrict its rare earth mineral exports to the U.S.
Tyler Kendall. Tyler, thank you. Tyler Kendall down in Washington, D.C. With us around the table here in New York, Henrietta Treyz of Veda Partners. Henrietta, good to see you.
You too.
Let's just get to this. Are we allowed exemptions or not? Do they exist?
I mean, under the IEEPA tariffs that went on that are already at 20%, there are no exclusions, except in the case of, like, if you're giving a donation from a religious entity. The semiconductors are tariffed. The pharmaceuticals are tariffed. Everything coming in, $498 billion, is effectively tariffed. So it's just going to get worse from here.
We're familiar with all these different buckets. Speaking of getting worse, sectoral tariffs. What would they look like and when would they be announced?
So I think that the 232 tariffs are the most pernicious kind that we can get. And in the 2025 environment, 30-day comment periods are pretty much all we should expect. We saw with the auto investigation back in 2019, was it? That they don't even necessarily release the investigation after it's confirmed. You know, they're just putting these tariffs on. So I think for pharma and for semiconductors, the worst case scenario is that sometime in this 30, 60, 90-day window, the tariffs go on, the comment period happens, and the tariffs are on before the summer.
What's the strategy here?
That's a great question. I mean, they want pharmaceutical manufacture back in the United States. We know that that takes 5 to 7 years to get the various approvals for even opening the facility, let alone having the workers come in and actually do the manufacturing on those kinds of products. I think that the semiconductor space is exactly the same. When I'm on calls with investors, they're talking about, thank goodness we had the investment from the last administration into semiconductors from the Chips and Sciences Act, a bipartisan bill that passed years ago, to keep, providing any kind of support to the industry because it's going to get slammed from the tariffs.
I'm just asking because the complications here are pretty dramatic. Trying to keep track of which tariffs have gone on where is a bold task when you try to talk about what the actual effective tariff rate is, let alone how you plan for the future and what that could be with additional rounds of tariffs coming on. What are people telling you?
That's the stories that I hear the most are the anecdotal data points, as you were talking before about connecting the soft data to the hard data. The bankruptcies that they're expecting, the seizing up at the ports, the manufacturers halting hiring, halting production, keeping their products on ships, in cargo ships. There's a lot of reminiscing about COVID era when the ships were just idling in the port. We're going to have to all go back to monitoring the Pacific Ocean and see what kind of fleets are out there. That's what folks are talking about now and anticipating seeing in the hard data in the next couple weeks.
Just got a message from a Bloomberg subscriber. This sounds very chaotic. The market seems to have priced peak chaos is behind us. What are we missing? What are we missing?
I don't think the stories have come out yet about how this is going to impact actual domestic manufacturers who rely on foreign imports. You were mentioning critical minerals before. How are you supposed to make, your windshield wiper sensors if you don't have the magnets that go into it? So if you stockpiled enough in the last couple of months to get in around that, you have some certainty for a couple of weeks, but that it's not a sustainable situation. I think the hard data is going to come out next for the next couple of weeks and months, and these tariffs are not going to come off, especially if they're done during under 232. Those are the most pernicious. 301 is pernicious. I mean, these have real staying power for years.
And then we need some relief. Taxes. What's changing with the tax push at the moment?
Man, you know how I feel about this. The tax component, they're now, President Trump is talking about it as tax cuts and deregulation. You are not permitted to pass deregulation via reconciliation instructions, and Democrats will not be working with Republicans on a crypto bill or any other deregulatory legislation. So unless you like the emission standards components, which are going to get reduced in a, $75 barrel oil situation, you're not going to see a deregulatory push anytime this year. And certainly not until you get certain agency officials seated in their positions in the first place. And then the tax bill, I think, is going to take until the end of July. And as you know, it includes $4 trillion in deficit increases and very little in the way of new stimulus. So I think there's a disconnect between the narrative and reality.
Given that, is there a loss of power that Trump is having, or a loss of a clutch over the Republican House caucus?
I don't buy that argument. They passed the budget vote last week, and I think that was the biggest hurdle. The next step is, are you going to vote for tax increases on every single American, or are you going to vote for this bill? And that's a cut and dry. The whip is easy. All members are going to support that.
There is this theory that if things get chaotic enough, and if some of these proposals are outrageous enough, there is going to be the ultimate check, which is going to come by congressional action against some of these tariffs, or potentially a court action. Do you see any pathway to that, or are people just wishful thinking?
No, I see no path for that either. If you can get 6 or 7 Republicans to join on to a Senate bill, that is wildly insufficient. I think that President Trump needs these members through this budget vote that happened last week, and now through, let's call it Memorial Day or July, to pass this tax bill. And then he doesn't need them at all. And no legislation is going to pass. There will be no reconciliation authority. There will be no more legislation, which is, by the way, the playbook from the first term, where we got a tax bill initially and then spent the next 3 years doing tariffs. And that's what I expect here.
Just quickly, are we at the point where they're all quoting Treasury yields to each other down on Capitol Hill?
No.
We're not there yet.
I'm not sure we'll ever be there. I wouldn't expect that.
I hope we never get there, because if we get there, we've got major problems.
Yeah. On one level, I kind of hope that they do pay attention, because it does actually matter. Suddenly, if you have a 50 basis point increase in 10-year yields, that increases by billions of dollars the amount that the United States is paying. So I hope they do quote those Treasury yields. Congress members, if you are listening, please get a Bloomberg terminal. Take a look at that 10-year yield. Take a look at the 30-year yield.
There's the sales pitch. I'm right there with you.
And plan
you get that
accordingly.
Bloomberg terminal. Clearly, the president was looking very closely last weekend coming into the trading week.
Yeah, it got yippee. People got a little nervous, but he dealt with that in one statement, and that's what he said. The issue is, do we have a true sense of where that Trump put is? Do we have a sense of what level, what type of chaos could potentially end up dealing with some sort of response from this administration?
Henrietta, it's good to see you.
Thanks for having me.
Thanks for dropping by. Thank you. Henrietta Treyz there of Veda Partners. In just a few seconds, Lisa, we'll be talking about the numbers coming from the likes of Goldman Sachs after what we heard from JP Morgan and Morgan Stanley going into the weekend.
Yeah, and the key question for me is how much these really represent the broader corporate American sphere, because right now they are seeing a benefit from increased income payments. And even though they aren't necessarily seeing any kind of M&A boom that a lot of people were expecting, they are seeing equity trading benefits. And so we expect to see that as well from Goldman Sachs.
Upside surprise on equity trading. The numbers just dropped. 4.19 billion, the estimate 3.8. The board also approving up to $40 billion share buyback program. We'll have more on this in just a moment. That stock is higher by 4%. Bassett will break down the figures, and we'll catch up with Gerard Cassidy of RBC for reaction. Live from New York, you're watching Bloomberg TV. Session highs in the equity market, positive here by 1.6% on the S&P, building on the gains of last week. Last week, the biggest weekly gain of the year so far. On the Nasdaq, 7 percentage point move on the Nasdaq 100 last week. Phenomenal. We add another 1.8% to it. Big tech story in focus this morning after the exemptions over the weekend. Big banking in focus now. Let's bring in Sonali Basak for more. Sonali, another beat on Wall Street.
Another beat, John. And not only are you looking at Goldman Sachs beat on equities trading, coming in with record revenue, overall trading is probably one of the best, if not the best, set of results we've seen since 2008, post-2008. You also have trading coming in with the best results in equities trading across all of Wall Street. They came in above Morgan Stanley. They beat on revenue, they beat on returns on tangible common equity, and they have a whopping buyback program as well, as you had mentioned a little bit before. Now, they missed on investment banking. A Goldman executive told me that there is actually a building of the investment banking pipeline. There's the fourth consecutive quarter of investment banking deals building under the surface. Now, the question is, when are these going to get done in IPO, M&As, and leverage finance? I would also turn to the commentary, John. David Solomon not mentioning tariffs in the quotes, but saying that they are in the second quarter with a markedly different operating environment than earlier this year. The main question will be, can they continue these trading gains as the environment turns?
Sonali, you touched on it. I think it's really important. Coming into 2025, confidence was sky high for some of these executives, particularly the investment bankers. Your point on that pipeline building, I think, is really important. The difference between activity delayed versus derailed. Sonali, what have we learned over the last few days?
A few things. One is that we haven't been able to see much debt financing. A lot of the deals in the pipeline are private equity related, John. This means all these companies that have borrowed for the last several years, waiting to get out the door, have not been able to. How fast does that window close is what I want to know. And how willing will lenders be to give these companies money when they are ready to go? And are strategics able to do deals with a regulatory environment that's frankly unclear? There's plenty to point to. Think about HP, for example, earlier this year. A lot of deal makers are pointing to U.S. Steel, highly uncertain. Still, even without the macro not working out, you have a lot of uncertainty with policy that is stifling deals too.
Do we have a sense, Sonali, of where Goldman Sachs' growth strategy is going to come from? We know that they had the consumer effort that they backed away from. They did report deposits coming up about 9%. They did underperform, though, when it came to wealth management. Do we have a sense of where beyond just the trading and banking business Goldman Sachs could potentially lean on?
Yeah, the asset and wealth manager are exactly where executives are pointing to. They have been pointing to that for months, for years now, to be the next steady revenue stream. In this quarter, very interesting, they actually posted a loss in their equity investments unit. Now, this is a small amount of money relative to what Goldman makes overall, but it is the place that they're trying to grow, asset and wealth management overall. They also missed on their debt investments that they hold as well, but they are reducing the size of their balance sheet. Now, this also leads to legacy. It's President John Waldron. He's been building this business. It's Mark Nachman, who's been over at that business as well. All of these folks are kind of the next generation of Goldman Sachs, and building that business is why you're not seeing them get the same multiples with companies that already have those businesses built out in a larger way, like JP Morgan and Morgan Stanley. JP Morgan is trading at 2x book. You have Goldman trading at 1.4.
Sonali, appreciate the update. As always, Sonali Basak there breaking it down. That name in the pre-market up by 2.5%. Two headlines jump out here, Lisa. One, big upside surprise on equity trading revenue. Following some upside surprises elsewhere on the street, that number came in at $4.19 billion, the estimate $3.8, approving a share buyback program of up to $40 billion.
Which mimics what we've seen from other banks as well. And we expect to see more of the same, especially if they're getting their stocks at a discount. That stood out to me. The other thing that stood out to me was that their advisory revenue came in light at $792 million versus the estimate of $910 million. The reason why I thought this was interesting is it goes to this question of derailed or delayed. How much are these businesses? How much is it really building a pipeline versus something that is a shift in terms of people feeling like they can get deals done?
Let's get the view of Gerard Cassidy of RBC. He's back with us. Gerard, welcome back to the programme, sir. Your take on Goldman with those numbers out just 4 minutes ago.
John, thank you. The numbers were very strong, as you guys have just talked about, particularly in the equity trading area, trading in all of the big firms that we saw on Friday and today. in equities was better than expected, and Goldman certainly delivered, as did they in their FIC trading or fixed income trading. And similar to the other big banks, investment banking was on the light side. But overall, a really good quarter. And the buyback announcement, 40 billion of potential buybacks in the future is also a positive. And that's a positive for the group. That's one of the reasons investors can own the group, is the return of excess capital.
Gerard, let's talk about that buyback. $40 billion on a market cap of what? Almost 160. It's pretty phenomenal stuff, Gerard.
It sure is. And in fact, John, looking at my numbers here, if you go back to the peak level of shares outstanding for Goldman Sachs, which was back in the first quarter of 2010. So this is post-financial crisis. Banks had to issue equities to get through the crisis. Their share count has fallen over 45% since that time. This is one of their active strategies, and they do it very well.
Goldman Sachs shares are down some 13% this year, so maybe they are also seeing a chance to get in while its shares are cheap. How much do you see this being a strategy for banks more broadly as we await Citigroup and Bank of America?
Lisa, I think it's going to be a very important part of the strategy for banks, particularly with this new regulatory environment that we're expecting under Treasury Secretary Benson, as he reduces the corset. He's pointed out that the regulations around the big banks is like a corset. He's going to loosen it up. And in doing so, I think this is going to enable the banks to give back even more capital. So I think it's a strategy all the big banks will be using in 2025.
All of the banks have reported really strong revenues from equity trading, little light on the fixed income currencies and commodities trading. What was it about the equity strategy that was so successful in the first quarter?
I think what we saw, Lisa, was the volatility. The banks have always pointed out to us in trading, volatility is their friend. And it's not their friend in investment banking, and you're seeing that as well. But because of the volatility, these big players like Goldman, Morgan Stanley, JP Morgan, we expect similar trends for Citi and B of A, they get very active in facilitating trading for their clients. And in doing so, it makes it very profitable for them.
If you are just tuning in, welcome to the programme. Goldman trading higher in the pre-market. The stock is up by 2.3%. The numbers came out just moments ago. Upside surprise on equity trading revenue. That came in at $4.19 billion. The estimate was $3.8. FIC a little bit lighter, coming in at 4.4, and the estimate 4.47. Approving a share buyback program of up to $40 billion. Pretty punchy stuff supporting the stock there. But let's talk about that lighter note, Gerard, that you referenced. So investment banking revenue coming in a little bit lighter at $1.92 billion. The estimate $2.03 billion. We've been talking about this subject around this table for the last several months. Into 25, Gerard, as you know, confidence sky high that we'd make deals, we'd see IPOs. It hasn't happened in the way that we'd anticipate. And the question we keep going back to, derailed or delayed? Gerard, do you have any confidence that it is just delayed?
John, I mean, it's a great quote. I think you put your thumb right on it. And at this point, I think it's delayed. A little too early to jump to the conclusion that it's derailed. And the reason being is that many of these companies are waiting for calmer markets, more settling in the markets. Hopefully we'll get that at some point this year after the tariff situation settles down. But once it does settle down, I think you're going to see a lot of activity in the ECM market and the advisory market as well. The advisory market has been subdued for a number of years, and companies have always used acquisitions as part of their organic growth strategy, and we expect that to continue going forward.
Gerard, can we spin this into a broader statement here? Because we've seen banks report earnings that are really positive, that have beat pretty much across the board. And then we've heard some negative rhetoric, particularly from JP Morgan's CEO. We've heard the similar kind of uncertainty around tariffs from Morgan Stanley. Is there a note of confidence when you actually look at the nuts and bolts of some of these financial earnings, given the fact that actually credit loss provisions at Goldman Sachs actually went down, not up, that they expect that these deals will come, but just later in the year?
Lisa, it's really an interesting question because the core fundamentals in the first quarter for some of the regional banks have already reported, like in M&T this morning, and on the credit, very strong for them. Like you just mentioned on Goldman, Wells Fargo last week had strong credit numbers as well, as did JP Morgan. So I think the core business in the first quarter was very strong. What's so unsettling right now, however, is the uncertainty of what we could see if these tariffs go through and the economy slows. We know a slowing economy will weaken the fundamentals for the banks, but we have to remember the banks today are in such strong shape going into this vis-a-vis what we saw in 2007 when we went into the financial crisis of 08-09. So it's a different ballgame entirely. The banks are strong. They have very strong fundamentals. And most importantly, they have a regulatory environment that's now constructive, not confrontational.
In this different ballgame, Gerard, which banks have the best profile to actually profit? Is it the trading banks or is it the lending banks? Is it the Goldman Sachs and Morgan Stanleys or is it the Bank of America's and Citigroups?
It's going to be today, obviously, the investment banks and the trading operations are doing much better than the lending operations. But I think if the economy settles down and we get back to growth and we go back to building out plant and equipment and capital expenditures pick up later this year, then the lending will take over as the driver of the revenues. But as of today, as you saw from Goldman's numbers and the others that have reported, trading has really stood out as the outstanding area to be in today.
Let's finish on the names that haven't reported. We'll hear from Bank of America and Citi, Gerard, in the next few days. What do you expect to hear now you've seen all of this?
I think we're going to see very similar numbers, John, on the trading side. We would expect both Citi and Bank of America to put up both strong equity numbers and the FICC trading numbers. They'll probably come in light on ECM and advisory, similar to, again, the others. And DCM will be pretty strong for those names. More importantly, what's going to be interesting for both of them is what they do on credit. We expect, Citi, because it's global and has higher risk, maybe the provisioning comes in a little higher, but Bank of America may look more like Wells Fargo or a Goldman in coming in with a provision something a little lighter because their credit is holding up better.
Interesting. Thanks for the update, Gerard. Appreciate it. The reaction live to Goldman earnings dropping just moments ago. Gerard Cassidy there of RBC. You've got to draw a distinction between what they're telling you and what they're doing. What they're telling you sounds really cautious. What they're doing, Lisa, what have we seen across JP Morgan and Goldman Sachs? JP Morgan raised the outlook. Goldman Sachs came out with a buyback of up to $40 billion. That's what they're doing. It's very different to what we're hearing elsewhere.
Which gives the sense that either, one, they're better positioned than many other companies in the United States. They're uniquely positioned to benefit at a time of turmoil, given some of the trading revenues that could come from that. Or the second thing is what they're hearing from clients and what they're seeing in the business community just isn't matching the rhetoric that we're seeing in the soft data. It goes to the question of the soft data versus hard data. Is the soft data giving a signal that isn't going to come out in the same kind of way in the hard data? And that is the ultimate question for so many.
Here's some hard data for Goldman Sachs. Equity trading revenue rose 27% from a year earlier, posting their highest quarterly revenue haul on record for that division. That stock right now up by 1.7%. With an update on stories elsewhere and more, here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John, just another quick recap on Goldman Sachs, which shares are higher by 1.7% in the pre-market. It posted a record revenue haul from its equity trading unit, up 27% from a year earlier. The board also approved up to a $40 billion share buyback program. Elsewhere, growth in Goldman's deal-making machine remains challenged by broader market volatility. The company's investment banking revenue coming in 8% lower than last year. President Donald Trump pledged that he will still apply tariffs to phones, computers, and popular consumer electronics. The comments downplaying a weekend exemption as a procedural step in his overall push to remake the U.S. trade system. The president telling reporters aboard Air Force One that his decision will come soon. And in sports, Rory McIlroy has added the long, elusive green jacket to his resume with a win at the Masters. McIlroy ended a decade-long major drought in dramatic fashion, recovering from 2 double bogeys to reach a playoff round against Justin Rose. McIlroy then hit a stunning drive to set up birdie on the 18th hole, beating Rose by 1 stroke. The win marks his 5th major title. He is now the 6th ever player to achieve the career Grand Slam. And that's your brief, John.
Congratulations, Rory, once again. Danny, thank you. Appreciate it. Up next on the program, a temporary reprieve.
The president is going to come out with his policies on semiconductors and pharmaceuticals. They're going to be outside the reciprocal tariffs. We need to have semiconductors. We need to have chips, and we need to have flat panels. We need to have these things made in America.
That conversation coming up next with Vivek, Arya of Bank of America. Live from New York City, this is Bloomberg. So here's the state of play this morning, and good morning to you. Equities near session highs, up by 1.5% on the S&P, on the Nasdaq up by 1.7%. Moments ago, numbers from Goldman Sachs. Upside surprise on equity sales and trading revenue. And then you've got the additional up to $40 billion share buyback program. So throw that into the mix as well. That stock is up by 1.5%. This line came from David Solomon, the Goldman Sachs chief executive here, Lisa. We are entering the second quarter with a markedly different operating environment. And that's the story, really, isn't it? Where we are now compared to where we thought we would be only 3 months ago.
Yeah, he goes on to say we remain confident in our ability to continue to support our clients, which I don't know what that means, but evidently they're going to be a solid bank and they're going to buy back their shares. It's a way of saying a lot of something has changed without really weighing in at all on it, which is kind of this theme that we've gotten. How do you comment on the unknown? And so many companies have grappled with the same, especially when you're faring off with an otherwise really solid balance sheet. And that's how he dealt with it. It's markedly different. We're here. And that's, I think, the kind of ambiguous rhetoric you're going to hear from a lot of CEOs.
The investment banking activity we didn't get. We keep going back to the same question. Delayed or derailed? And a lot of people we speak to keep going with delayed and not derailed.
Let's put some numbers on it. People expected the investment bankers to come out with $2 billion of revenue. It came in at $1.91 billion. They did say their backlog increased, but that is a decrease of 8% from last year at a time when people had expected that revenue to be the driver of a lot of bank profits.
That stock is up by 1.5%. That's the latest from Goldman and the latest earnings on Wall Street. Let's turn to tech. Under surveillance this morning, a temporary reprieve.
The president is going to come out with his policies on semiconductors and pharmaceuticals. They're going to be outside the reciprocal tariffs. And he was just making sure everyone understood that all of these products are outside the reciprocal tariffs and they are going to have their own separate way of being considered. We need to have semiconductors. We need to have chips, and we need to have flat panels. We need to have these things made in America.
So here's the latest this morning. The Trump administration saying a separate semiconductor tariff is coming, downplaying an exemption announced over the weekend. According to 2024 Treyz statistics, the exclusions cover almost $390 billion in U.S. imports. Joining us now to discuss is Vivek Arya, the senior semiconductor analyst over at Bank of America Securities. Vivek, welcome back to the program, sir. Help us understand what some of the companies that you follow are doing at the moment to respond to all of this volatility in policy.
Sure. I think it's important to understand that the semiconductor and electronics supply chain has been formed over decades, right? We have materials that come from Japan. We have a lot of design work that gets done in the US and Europe. A lot of the leading edge chips are manufactured in Taiwan. A lot of their back-end processing is done in Southeast Asia. Then a lot of the assembly lines are in China and so forth. So the supply chain has been built over decades, and we certainly understand the importance of insourcing more to the US. But it's going to be a long and complicated process, despite the right motivations in place. So what we are hearing from the company is somewhat a state of there is a freeze in their thinking, because they are not sure exactly what the rules of the road are going to be. They're not sure how many of these tariffs are going to be followed through. They are not sure where and how and when they would need to relocate their production. So I think there is a little bit of a sense of freeze among the companies that we follow, which is not good for the industry.
That's the rules of the game in the future. I think people are struggling with what the rules of the game are right now. China also has tariffs on the United States too. The US has got tariffs on China. They've both been responding to each other. Can you help us understand what is and isn't getting a tariff right now? Who is and isn't exposed to these numbers?
Sure. So the first thing is, when we look at the tariffs that China intends to put on the US, there's only a handful of companies that make semiconductors here in the US that are actually exported to China. So Intel and Texas Instruments are among them. But in many cases, Intel and Texas Instruments have a production overseas. So some of it can be used to satisfy China demand. So I think in terms of China placing tariffs on US companies, it is a bit of a bother. It is going to impact a handful of companies. But I think for the most part, the sector should be able to work around it. I think the bigger challenge comes in terms of the tariffs that the U.S. plans to put on electronics that are assembled in China. That is where we have exposure for some of the most important categories in electronics, especially smartphones and some level of PCs. And I think that's where the industry is most worried, because of how the supply chains have been built up over the last few decades, as I mentioned. I think that's what the industry is really trying to get their arms around and make sure that whatever they can to try and either postpone it or try and minimize their impact. And I think that's why we think that what we heard yesterday, even though it's not the best news in terms of just completely removing all those tariffs on electronics, still a reprieve offers the industry about 1 or 2 months of time to go and make their case to this White House that moving all this production to the U.S. is not going to be that easy.
Vivek, we did hear from Howard Lutnick, the Commerce Secretary, that the ultimate goal is to move supply chains away from Southeast Asia. And you've been mentioning this has been a supply chain that's been built up over decades. How long would it take to bring that back to the United States to do as what Commerce Secretary Lutnick said, which is we need to have those things made in America?
Absolutely. And I completely agree, I think, with that objective. Just like iron and steel and energy have been important parts of the global and the U.S. economy, and insourcing them has been a priority. I think so is the case for semiconductors, not just for the U.S., but every country in the world, that these are very critical inputs to a very critical electronics industry. And in some ways, we are starting to see that ball move forward. I think the U.S. CHIPS Act was an important first step in kind of getting this process started, which is why we have seen Taiwan Semi start to invest in fabs in Arizona. And they renewed and expanded their commitment to $165 billion under the Trump administration. We have also seen media reports about TSMC wanting to perhaps do a joint venture with Intel. I think that can also move the ball forward. But I think it's important to understand that these things don't happen overnight. Building a leading edge fab can take years. It can cost over $20 billion. And you still have a lot of the back-end assembly and testing outside, and a lot of assembly of these electronics outside. So I think parts of the process we can move over to the U.S. over the next 2 to 4 years. But a lot of the other parts of the back-end, I think, are just going to be too cumbersome. So we'll have to find a compromise somewhere in between.
Let's see if we can find it. Vivek, appreciate your time, sir. Thank you. Vivek Arya there of Bank of America. Lisa, they've correctly identified the issue. This is a national security problem. With that, there can be no debate. And there is massive agreement down in Washington, D.C. about that. It's how you address that problem, how you encourage, incentivize those people to develop that manufacturing right here in the United States.
And how much time you give them to actually engage with some sort of transition, given that it has been built up over decades. What the market is grappling with is the ultimate goal in its general concept. Most people would agree with in the United States on both sides of the aisle. The question is the path to get there, how much pain is required, and what the U.S.'s profile is with the rest of the world. They're trying to do a lot of things at once, and people are getting kind of confused.
Hitting the ground very quickly. Equity futures at the moment rolling over just a touch, still positive, just off session highs. We're up by a little more than 1%. Up next on the programme, we'll catch up with Kennon of Clear Harbor Asset Management. We'll speak to David Ellison of Hennessy Funds, Greg Daco of EY, and Noel Dixon of State Street. The third hour of Bloomberg Surveillance is just around the corner.
If we've got a world of higher uncertainty, probably higher volatility, slower growth, you've got to adjust the portfolio accordingly.
It's more likely that we revisit the lows than we don't.
It's going to be hard to find a bullish or optimistic investor right now.
We have to be careful not to read too much into one-day moves and extrapolate them into the future.
What we're looking for is a very choppy year, unfortunately.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning to you all. It's a calmer morning on Wall Street. Equity futures are firmer by 1.2% on the S&P. The third hour of Bloomberg Surveillance starts right now. We had some weight to the Nasdaq 100 after a major rally last week. A gain of 7% plus on the Nasdaq 100, up again this morning by 1.5%. And we have some stability in the bond market, which I think is really encouraging news. Let's see if this sticks. We're down 5 basis points at the front end on twos. On a 10-year, we're down 5 to 443, following a 50 basis point move higher just last week alone. Coming up through this week, you'll get more earnings. and you'll get more data. We'll hear from Bank of America and Citi tomorrow. You'll hear from United Airlines too. Then on Wednesday, you'll hear from the chairman of the Federal Reserve, Chairman Powell, later this week.
How much confidence can he give that the Fed truly will step in at some point should that sell-off in the bond market continue? You mentioned that stability. That is key for so many people this week. If we get that stability, can you breathe life into this idea that we just saw a leveraged fund unwind? To me, my most interesting part of this week might be United earnings. If you get them after the bell tomorrow, how much do you get a repeat of what we saw from Delta?
Let's unpack that. If you lose confidence in the risk-free asset, how can you have confidence in anything else? And certainly last week, confidence was damaged. The confidence then needs to come from the earnings and come from the data. I'm with United Airlines and then retail sales later this week. How's the consumer doing? We know how they feel. It's not great right now at all. What are they actually doing?
It goes to the gap between soft data and hard data. Soft data, the sky is falling. Hard data, as we hear from all of the banks, things are okay. We're still here. We're making money. There is a question going forward of when you start to see that shift. United might follow in Delta's footsteps, where they are seeing a market shift when it comes to some of the deterioration, particularly in domestic travel. I'm also interested in international travel, and you kept mentioning this. Are inbound flights going down from international visitors to the United States at a time when potentially this is a U.S.-centric problem at a time where the issue is U.S. policy uncertainty?
So that's the story for the week to come. Let's talk about the uncertainty over the weekend. Got to make sense of this. So over the weekend at the beginning, it looked like we had exemptions, some big wins for the likes of Nvidia and Apple. And then the Commerce Secretary, Howard Lutnick, came out and said, no, those tariffs are just going to come from a different bucket. Jamieson Greer, the US trade representative, saying it's not really an exemption. That's not even the right word for it.
So to me, this all kind of summed up as, don't call it a pivot. Don't say he caved, because this is just the beginning. And we're just shifting the bucket from the 145% bucket to the 20% fentanyl-related bucket on China. It is unclear what the policy is going to be. The reason why people have any confidence whatsoever from this with respect to the tech trade is it takes the worst-case scenario off the table for now. That tail risk of a potential complete decoupling, immediately severing with no discussion, is now not on the table. There are 90 days for tech giants to get to Washington, D.C., get their lobbyists in place, and get a sense of what actually makes sense for them to have enough breathing space to bring production back to the United States and comply with some of the ultimate objectives of this administration.
In the short term, as we often say, markets care about better versus worse. Things are better. In the long term, we have to think about good versus bad. For some of these companies, this is not good, that's for sure.
It materially increases the cost of their doing business. And even more than that, what we have heard repeatedly from guest after guest this morning, how do you put a number on these tariffs is one thing. How do you put a number on what tariffs will look like in a month, 2 months, 3 months? And then how do you plan accordingly for supplies, for pricing, for staffing, for store placement? It becomes paralyzing for a lot of companies.
It's going to be a long year, isn't it? Equity futures right now in the S&P still positive by 1.2%. Coming up this hour, Aaron Kennon of Clear Harbor on navigating heightened volatility. We'll catch up with David Ellison of Hennessy Funds reacting to the latest bank earnings, and we'll speak to Noel Dixon of State Street on why he's still optimistic for US assets. We begin this hour with global stocks rising following the biggest weekly gain so far this year. Aaron Kennon of Clear Harbor Asset Management writing, we continue to anticipate elevated volatility, not only as tariff policy evolves in the coming weeks, but also as mounting recessionary headwinds signal further economic deterioration. Aaron joins us now for more. Aaron, welcome to the program, sir. I'm pleased you included that last line, because this is increasingly going to become more and more important in the weeks to come. What are you anticipating from the hard data for the United States?
We started to see some signals late last week with the University of Michigan, Jonathan, of course, indicating that consumers are really on their heels now. They're anticipating higher prices due to this tariff war, and they anticipate employment to start to soften. We're going to see probably the employment side through jolts later on in the month, almost the last couple of days of the month. And we're not going to see real inflationary data until the last bit of the month. So this is going to wait into May. But I do think the central question around this tariff debate, Jonathan, if I could, is important leg of the stool, as articulated by the administration, is the degree to which tariffs are going to be revenue generative and help offset this massive fiscal deficit that we have running at, call it 7% of GDP. Where they seem to be backing down is on that important leg of the stool. And I think to the extent that they continue doing that, that could trigger further risk-on movement. To the extent that they continue to muddy the waters as they did over the weekend around objectives, that could prove another de-risking event where gross de-risking happens and degrossing and de-risking happens going forward.
De-risking hasn't benefited treasuries. So let's maybe go to that story. Let's say the hard data catches down to the soft data. I don't know if that's your base case, but I just want to explore the possibility, the very real possibility that develops. How do you think treasuries will respond in that moment? Have we moved on from the events of last week? How do you think about the situation at the moment? And do you believe there has been a real reassessment of America's safe haven status or not?
I think our brand has been marred a bit, and I think it can be recovered. I think it's around the tariff question. We're very concerned. You had a weaker dollar last week, and you had higher interest rates. I mean that's not a healthy. We know Bessent's objective is to reduce rates. We know Trump's objective is to reduce interest rates. He's been twisting the arms of the Fed to reduce interest rates, and certainly that meeting in the Oval Office that has been well reported now was heavily around a dislocation in the fixed income markets. I think if we continue along this current path of uncertainty where objectives are not stated, I mean, gosh, we sit around the kitchen table and we state objectives when we communicate with our children. We're here in the office communicating objectives when we have an issue we need to talk about. We don't really know exactly what the objectives are. And interestingly enough, on foreign policy over the weekend, the Trump administration did state an objective with Iran. We do not want Iran to have a nuclear weapon. They stated an objective. That's what you do when you have a debate. They're not doing this with tariffs. And it's going to continue to maintain, I think, an unhealthy level of volatility for the markets.
Well, and this is the key question, an unhealthy level of volatility for all markets, right? Not just equities, but for bonds as well. What's going to be the main driver for the bond market? We were hearing earlier from Peter Tchir that ultimately this also stems from the idea that the budget deficit isn't going to get curtailed anytime soon, and that all of the proposals in Washington right now speak to an expansion of debt and deficit. So how much is that going to be a major driver of the volatility versus policy uncertainty that causes dislocations in levered funds?
Yeah, I think there are two interesting ways to look at that, Lisa. One is the traditional, which is, well, if we have slower growth, we're going to have a flight to quality in the Treasury market. The other one is, no, this is a Liz Truss sort of moment for U.S. Treasuries. And to the extent that this tariff schematic continues to not just breed uncertainty, but to reduce the need, if we're not going to be trading as much with China, they don't need to maintain as many dollar reserves. If they don't need to maintain as many dollar reserves, and they may actually need to support their own currency because they're importing energy and other important inputs, well, it's not retribution, it's economics. They would then sell those dollar reserves, and in doing so, that could put pressure on the Treasury market. There's a huge tug of war going on right now. This morning, the more traditional perspective is outweighing things. But mid last week, certainly we saw that Liz Truss moment weighing on the conversation in the Oval Office, in my opinion.
Aaron, how much have you changed the way you allocate as a result? Have you? Because we hear mixed things. Some people come on the show and they say we haven't moved anything. Steve Chiavarone still modestly overweight equities. And then we heard from Greg Peters of PGIM Fixed Income last week, who said this is a sea change. And it really does raise these existential questions for the bond market. Where do you stand on this?
Yeah, I think, in some ways, I think about it in the context of, well, the 60-40 portfolio hasn't died on a year-to-date basis. You have the Bloomberg Aggregate Bond Index up over just 1%. You have equities off mid-single digits in the U.S. You have equities up in Europe by about 700-800 basis points on average year-to-date, not including today, which is up another % or so. But then you have the other components of what it means to diversify a portfolio beyond just sort of treasuries. And we believe the treasury piece still has merit, particularly with break evens where they are. But gold's up 23% year to date. We own that in some portfolios where we're really trying to create balance. You look at the alternative segment, merger arbitrage is up a bit this year. Stat arb is up. Market neutral long short equity is up. So there are different ways to diversify the portfolio that are working really well this year and create real ballast against this sort of long duration treasury volatility and economic uncertainty that's feeding into lower equity levels, at least on a year to date basis in the U.S.
Let's just finish on gold. 32.25 this morning, down a touch. We're down 0.4%, nothing compared to the rally and the all-time highs we've seen. Goldman out. Goldman saying we could test 3,700 an ounce by the end of the year and maybe go even higher. What's benefiting gold, Aaron, from your standpoint? What's driving the success of the yellow metal?
So gold's an alternative currency. We know the Dixie, the dollar index, was at 109 not too long ago. Back in January, it's at 99 handle today. So weaker dollar tends to, on the margin, be a net benefit for gold. But I think there are other things going on here. We have central banks that are looking for alternative ways to allocate their reserves outside the dollar. I mean, part of that is due to this tariff spat, which is just accelerating that trend. But this started back in 2022, Jonathan, when Russia invaded Ukraine and we shut off dollar access to Russia. Think other countries like China, Iran, maybe even some of our, countries that we do trade with, but that may be a little skeptical of our relationship around Saudi Arabia. They seem to be accelerating purchases of gold going forward. And I don't think that there's really a catalyst for that to necessarily reverse anytime soon. So I tend to embrace the thesis you just articulated.
Interesting. Seen a series of record highs over the past year. Aaron, appreciate your time, sir. Thank you. Aaron Kennon there of Clear Harbor Asset Management. Certainly seen evidence of that reserve diversification over the last several years building repeatedly.
And we've heard central banks actually say that that was the strategy they were going to engage with. And typically, we've been speaking with experts in the field, and they say, if you hear a central bank say that, they're on the beginning of a multi-year strategy. This isn't a 2-week discussion about whether we should buy gold.
You know who used to be focused on this? The Treasury Secretary before he was the Treasury Secretary.
What do you think Treasury Secretary Scott Bessent would be doing with a long-short hedge fund right now, or a macro hedge fund, if he were on the other side of this?
It's something I've given some thought. I'm sure that gold position would be in the mix.
Yeah, I'm pretty sure it would.
Based on what he communicated before, but I can never get into someone's head. It's a risky business trying.
Well, maybe Annmarie can later today.
She's going to give it a go. She can ask him directly. I'll see if he answers. Annmarie sitting down with the Treasury Secretary, Scott Bessent, later on this afternoon at 4 p.m. Eastern Time. That will be live from Argentina, so look out for that conversation a little bit later. Let's give you an update on stories elsewhere this morning with your Bloomberg brief. Let's cross over to Danny Berger. Hey, Danny.
Hey, John. President Donald Trump pledged that he will still apply tariffs to phones, computers, and popular consumer electronics. The comments downplayed a weekend exemption as a procedural step in his overall push to remake U.S. trade. The president telling reporters aboard Air Force One that his decision will come soon. Chinese President Xi Jinping has landed in Vietnam for his first trip overseas of the year. The Chinese leader is expected to present China as a more stable trading partner than the U.S. under President Donald Trump, whose shifting tariff policies have rattled markets. Elsewhere, Meta faces a landmark antitrust trial today. The FTC alleges that the tech giant acquired Instagram and WhatsApp to eliminate competition and maintain a monopoly. Meta says that the acquisitions were approved by regulators over a decade ago. And that's your brief, John.
Danny, thank you. More from Danny later this hour. Just a word on that story. It's up to them to take care of business in the courts. I get all of that. But the benefit of hindsight. At the time when these acquisitions were made, I remember covering them. I was in London at the time. I'm sure you remember covering them here in New York. People thought they'd overpaid for the assets. I remember people thinking the numbers were absolutely crazy.
They're going to argue, and I'm talking about Meta, that this is revisionist history, and you can look back and say, now, with 10 years of hindsight, wow, they have a monopoly. But at the time, it was actually highly skeptical. It goes to this question, too, of the Trump administration as having the same approach as the Biden administration when it comes to antitrust, at least when it comes to big tech.
Nasdaq futures, at least this morning, up by 1.7%. Up next on the programme, the Morning Calls Plus, David Ellison of Hennessy Funds with bank earnings in full swing. That conversation just around the corner. Wilson and Morgan Stanley summing things up pretty well this morning. The worst may be over, but the coast isn't clear. Certainly feels that way. Equity futures on the S&P up by 1.3%. The squeeze continues. The Nasdaq 100 up by 1.7%. The Russell doing okay, up by 1 full percentage point. That's the price action. Let's get to some morning calls. First up, Wedbush reiterating its outperform rating on Apple. The analyst Dan Ives citing US tariff exemptions on tech components. Apple is up this morning by 6%. Your second call from Goldman, downgrading higher to sell, highlighting an increasingly uncertain backdrop for demand. That stock is down by 1.3%. And finally, Phillips Securities upgrading Wells Fargo to buy, expecting a slow but stable year for the bank. That stock is up again today by about 1%. Let's stick with the financials. Goldman Sachs adding to banking optimism after posting a record revenue haul from its equity trading unit. The stock is up by 2%. To discuss, I'm pleased to say, is David Ellison of Hennessy Funds. David, welcome to the programme, sir. Appreciate getting some time with you. We've heard from JP Morgan, from Morgan Stanley, from Goldman. How would you grade the quarter so far?
Well, the quarters were great. I think the industry is showing that they're have done a great job of dealing with credit and liquidity and capital, managing the buybacks. So I think it's like that's all in the past, unfortunately. But I do think the industry is in great shape to weather what's ahead. I think your conversation with Gerard Cassidy this morning sort of put it in focus. But I think the industry is in great shape. Doesn't mean the stocks are going to double or triple or go down 50%. But I think as an industry, they're ready for whatever happens in Washington, I think.
Let's talk about that. As a portfolio manager, just how defensive do these names trade in growth scares? And how has that changed over the last decade, say?
Well, I think since 2008, we've been worried about a credit cycle, worried about a rate cycle. We've had an inverted curve. So the financials have been, frankly, not the place to be for 10 or 12 years. And I think the color of my hair shows it. So I think the hope is that as we go forward here, there's going to be a little less pressure on them as they, in a sense, the tariffs are not attacking financial services products, they're attacking physical goods. And so I think people maybe are going to be more worried about the physical good traders and makers than they are about the financial guys. So we'll see. I mean, Wall Street finds a way to make money in all environments. People need to lend money to grow. The economy's not going to go to zero. And so I think, these companies could be the safe harbor that they haven't been for the last 10 or 12 years.
David, the narrative around banks has shifted. At the beginning of this year, it was the growth stock, given the fact that there was supposed to be a wave of deregulation as well as a boom in mergers and acquisitions and all sorts of deals. Now it's a defense stock where suddenly banks are buying back their own shares in pretty large quantities. We just heard about a $40 billion repurchase from Goldman Sachs. Which is it? Is it defense or offense?
Well, when you sort of have one guy deciding what the world trade environment's going to be and a bunch of other stuff, I think, you look for defensive names, and that means you look for good balance sheets, you look for capital, you look for liquidity, and you look for good managers. And I think the banks have that. And so, this weekend was pretty quiet on the Washington front, so the market's up. So I think the general move of the market, I think, is the market generally wants to go up, in my view, and it's being held back by sort of one guy making decisions about how the world's going to function. And that, I think, will calm down and I think we'll be okay on the other side.
Another way of sort of approaching the same question is which banks are best positioned for the next phase of whatever is to come? Is it the ones who are going to benefit from volatility in markets, trading revenues, some of the potential other opportunities there, or is it going to be the lenders? The Bank of America's, they're going to go out and actually be able to create credit at a higher rate based on where the Treasury yield is right now.
Well, I think one of the concerns I think that's coming up on the analysts that I've talked to and the companies that I talked to prior to earnings was that is this disruption going to really hurt small business and therefore hurt the lending of the traditional banks that we haven't heard from yet, but we will in the coming weeks. I think the big banks, they have the earnings, they have the, in a sense, network effect of having a lot of customers and a lot of data inputs about what's going on. But I think the overriding thing about this industry is that we need new products, we need innovation, and we need companies to do transformative acquisitions to kind of get them back on a growth path. They've lost so much share on the lending side to private equity and private debt and other sources of income that the loans just don't grow anymore. And so they need to do other things to get out of that box that they're in. And hopefully that will happen as we move forward with the new administration.
We've heard lots of people say the same thing, that we're expecting consolidation, particularly between the regionals and the smaller lenders, David. What are you anticipating for the year ahead on that front?
Well, it started off pretty good. I think that I don't think that's going to stop. I don't think whatever the administration is doing now is going to stop that. I think at the end of the day, the smaller banks know that they're losing share. They can't invest in technology. It's hard for them to compete with these new platforms that seem to be popping up every day. They're competing for deposits and loans. And so they need to get bigger. And that's, sort of the process that you see that in the marketplace. The bigger companies have the higher valuations, and the smaller companies are going to be left behind. So I think the market is telling you something, and hopefully the managers are hearing that and seeing it.
David, appreciate your time. Tricky moment for you all, I'm sure. David Ellison there of Hennessy Funds. You do all the work, and then one man comes out with a tweet, a post, an X, or whatever, a truth.
Yeah.
And all of a sudden, everything gets turned upside down.
You can feel the frustration. You can feel it in the notes. You can feel it in people's faces. You can feel it when people come in and they say, oh, my God, this was the longest week ever. And you could say, all right, it's not that bad. At the same time, it is very difficult to have any kind of overarching thesis or theory that you can follow if it all can get upended by a series of conflicting narratives that then leave you throwing up your hands and saying, I have no clue.
I keep going back to that quote from Stuart Kaiser of Citi because I think it addressed this moment so well over the last week or so. The least satisfying 5% plus rally on the S&P in recent memory. And we talked about it yesterday evening in our special programming. If you asked people to guess where the S&P 500 finished last week, if you didn't know, I think you might have thought the market was down and not up. It just felt brutal at times.
Chetan Aya over at Morgan Stanley, who is one of their lead economists, said without a doubt it was the most stressful week of my career in financial services. And yes, he has been on the street since going back decades and before 2008. So it raises this question. Is it just that it feels that way, or is it actually going to lead to some sort of financial consequence akin to those moments? It sort of goes to the hard versus soft.
Yeah, repeatedly.
And again, repeatedly, it goes down to, are we just feeling bad, but it's not that bad? And it goes to a psychology game.
A lot of that stress has been in the bond market. I can't offer you the kind of therapy that Lisa might be able to offer you.
No, I can't offer.
No therapy session right
look
now?
For,
okay.
A good one.
Bond yields are down this morning, so there's your good news. Your bright spot. Yields are lower by 4 basis points on the 10-year. 445 at the front end of the curve. 2-year yields are lower too. At the long end of the curve, stabilising is the way to put it here. Yields down just a single basis point on the 30-year after a big move higher last week. Up next on the programme, Greg Daco of EY, Noel Dixon of State Street from New York City. This is Bloomberg. Last week, your scores, the S&P up by 5.7%, the Nasdaq 100 up by 7.43%. And we wake up this Monday morning with more gains. Equity futures up across the board. On the S&P 500 up by 1.4%. On the Nasdaq 100 up by close to 1.8%. With 60 minutes until the cash open with some morning movers, here's Danny Berger. Hey, Danny.
Hey, John. Some news from Pfizer. Over the past few hours, they will be abandoning their obesity treatment. The company citing one of their clinical trials in which one patient developed a potentially drug-linked liver injury. This is a setback for them. They say they're going to continue to invest in early-stage obesity treatments. However, they are far behind the competition. Those shares down about 0.2%. To the upside this morning, much like you saw in general tech, Apple shares higher, 6.5% in the pre-market trade over those exemptions for electronics when it comes to tariffs. Of course, they might still have tariffs to come. It is just temporary, but for now, we're off to the races with this company down 20%, more than 20% from its peak, I should say. So a lot of bad news already priced into the shares. Rounding things out with more good news from Goldman Sachs. We got their earnings about an hour ago. Those shares are up 2.5%, much like their peers that we've heard from so far. A huge haul when it comes to equity trading. In fact, a record over the quarter that helped make up for some quieter activity on the deal-making and investment banking front. John.
Danny, thank you. Appreciate it. Certainly on Wall Street, no big scares so far. Bank of America and Citi still to come, but so far, pretty good.
It seemed like equity trading, as Danny was just saying, very much the star. Really interesting, mixed messages when it comes to the build in provisions for credit losses. We saw builds over at JP Morgan and some others. We did not see that at Goldman Sachs. How much noise are they preparing for versus actual weakness?
Look out for numbers in the next 24 hours or so from Bank of America and Citi. You'll hear from United Airlines as well, so lots of earnings still to come. Lots of data too, and a very important address coming from the Fed Chair, Jay Powell. Mike McKee has more. Good morning, Mike.
Good morning, guys. Well, and the question here, obviously, is do the tariffs still continue to overshadow the economic data? Because, as you mentioned, we've got some important numbers coming up, including one today that maybe you don't think about all that much, and that's the New York Fed inflation expectations number. We've seen big jumps in the Michigan numbers that have scared the Fed a little bit. Now, do we see that today in the New York Fed number? That would get people's attention. Import prices tomorrow. Everybody wants to know what effect the tariffs are having. And then, of course, retail sales and jobless claims later in the week. Those are going to be big deals. Friday, at least, we get off. No economic data on Good Friday. But a lot of Fed speak to go along with all this data, including, as you mentioned, the chairman of the Fed, Jay Powell, speaking on Wednesday. But pay attention to Chris Waller today. He tends to move the markets with his economic outlook, and he hasn't given one in a little while. So a lot of Fed speak to follow through on all of this data, including one on Friday, unfortunately. And I'll leave you with one chart here, guys, to show you what the impact tariffs can have. This is the 30-year mortgage as tracked by Bankrate. And you can see how it was going down and leading people to think maybe the housing industry could come out of it. But look what happened over the past week.
President Daley needs a day off. What's that about, hey, Mike? A speech on Good Friday. We'll reach out to her and find out. We did hear from Kashkari over the weekend. I'd love your reaction to this. I think investors in the US and around the world are trying to determine what is the new normal in America. We have zero ability to affect that destination. Has he got a lot of company on the FOMC?
Yeah, it's pretty much unanimous in that view, John. Everybody thinks that at this point, the Fed is completely sidelined because it has zero visibility. If inflation goes up, they can raise rates or leave them where they are. If we see the economy fall off, they can cut rates. But right now, they have no idea what's going to happen.
Mike McKee, none of us do. Appreciate it, sir. Thank you. Which is why consumer confidence has been hit so much. Mike mentioned the numbers coming from the University of Michigan on Friday. A much-watched anticipatory read on what's going to happen with inflation, what's going to happen with things like unemployment. Inflation expectations are now at multi-decade highs. And anxiety about unemployment near levels we haven't seen since 2009. Greg Daco of EY writing the following. Higher tariffs will lead to a renewed inflation impulse in coming quarters, with core CPI inflation likely to end 2025 in the 3.5% to 4% range. Greg joins us now for more. Greg, welcome to the programme, sir. Can we start on Friday? The numbers from you, Mitch, are absolutely awful. Do you anticipate seeing any of that in the hard data in the months to come?
Yeah, I certainly think we're going to see some of that sentiment reading filter through to real economic activity. Already one of the factors that we've seen is the fact that many businesses are in a wait-and-see approach. Many consumers are more and more hesitant. And let's not forget that we were already in an economy that was slowing before all of this tariff uncertainty and the implementation of massive tariffs across most trading partners. That's very important. The pillars of the U.S. economy were not collapsing, but they were becoming more fragile. And that type of environment, on top of which you add an inflationary impulse from tariffs and more hesitancy from businesses and consumers, risk pushing the economy towards a more than desired, for sure, but very severe slowdown in terms of economic activity.
Greg, where are we going to see it first, given the fact that people are raising questions? We were talking to Nela Richardson of ADP earlier, saying we probably aren't going to see it in the employment rate, certainly not in the next month, maybe not the next few.
I think we're going to see it in the unemployment rate in the next few months, because we were already in an environment where we had a slowdown in hiring. Businesses and business executives were very cautious as to who they hired, for what skills they hired, and at what salary they hired. Going forward in an environment where there's tremendous uncertainty about final demand growth, about CapEx, and about hiring, and potentially more strategic decisions to essentially right-size labor forces across multiple sectors, you're going to see some movement up in the unemployment rate. Sadly, that's a consequence of a higher inflation, less growth environment, And I think that's going to be the case that leads to even more caution on the part of consumers, because on top of inflation, consumers will be facing this environment of weakened employment conditions.
Greg, how do you square that negativity with some of the rhetoric that we're hearing from companies on their earnings calls? Certainly not, Goldilocks, certainly not coming out with these really bright prognostications, but certainly showing a lot of strength in their numbers and in their forecast for what's to come.
It seems like we're numb, essentially. We're numb to an environment where we now have tariffs, despite all of the movements, tariffs that are at a 100-year high. I think people tend to forget that. And that's because we've seen all of these different announcements and walkbacks in terms of tariffs, an on-off approach that is extremely confusing and somewhat numbing. So I feel numb today on Monday because we are in this environment where you were just talking about the stock market performance last week, positive, ending in the green. Yet we have the highest tariffs we've seen in 100 years. And we have businesses that are very much hesitant to do much of anything, whether it's CapEx, hiring, or deal making. There's a lot of hesitancy until there's going to be more clarity as to the longer term picture with regards to tariff. That's all we need. We need more certainty as to what the landscape is going to look like, not just for the next day or two, but for the next few years as to what the landscape is going to look like. And that would in and of itself be a big support to the economy, because right now, uncertainty is at an all-time high. We have volatility that is at an all-time high, and all of those factors are constraining economic activity.
Greg, I'm pleased you went there. I think these numbers are so large, they're almost impossible to really internalize. Really difficult to try and process. To look at the numbers on China now, this came from Capital Economics, and we keep going back to this quote from Paul Ashworth. The effective increase on China, even once those exemptions over the weekend are accounted for, is still closer to 100%. Greg, what on earth does trade between the US and China look like in the next few months?
We really don't know. I think what businesses are doing right now is they're holding off on orders, which is actually in and of itself a factor that is constraining economic activity, because when you have less of these orders, it does hurt economic activity. You're absolutely right about the average tariff rate. The average tariff rate has increased 27% to nearly 30% on all of our trading partners. And as you were just saying, our average tariff rate vis-a-vis China is something that is unconceivable, or was unconceivable just a few weeks ago. So we are in this historical environment where you have the cost of traded goods that would put upward pressure on inflation, continue to feed financial market volatility. And I don't think we're out of the woods here in terms of the appetite for US denominated assets. Whether it's treasuries, stocks, or the US dollar, they're still all going to be under tremendous pressure in an environment of hyper protectionism. And I think that's a key risk to continue observing very closely.
Hey, Greg, appreciate it. As always, sir, thanks for jumping on. Greg Daco there of EY. The market's preoccupied with up and down. Are the tariffs higher or lower? We've almost forgotten where the tariffs are at the moment, and the tariffs are still incredibly high.
Well, this is the point, actually, and I think that Greg really summed it up with the fact that he feels numb. I think a lot of people feel numb. There is a question about whether people are numb to the idea of this becoming a reality because they say that the tariff rates are so high that they are kind of like what China said, not realistic. They're almost a joke. They can't be real. There are so many people that come on, they're looking for off-ramps. They're not taking it seriously and literally. Economists who come out with some pretty fantastical numbers that represent some pretty shocking situations. So how do you factor this in if you're an investor who doesn't understand whether to take President Trump literally or seriously?
With great difficulty. So we get you some optimism. Noel Dixon of State Street writes this. While the next month or so will be bumpy, the second half of the year will be a good story for US assets. I think we ultimately avoid recession. Noel joins us now for more. Noel, good morning. Good to see you.
Good morning.
Big picture then. Why is it going to be so good in the second half?
Yeah, so I think right now a lot of bad news has been priced into markets, and I do think ultimately we avoid a recession. And when I say recession, that's the NBER's, National Bureau of Economic Research's definition, which factors in real income, non-farm payrolls in the household survey. But I do think what will happen is we'll grow below trend. And what that'll do is that'll actually help with the cyclical part of inflation, the part of inflation that the Fed's been struggling to get control over in the past few years. And they'll be in a position, I think, to cut a couple of times in the second half.
What are your assumptions on tariffs from here? How do things change?
So I do think we're in the negotiation phase. I think we are getting some certainty. I just think markets haven't been liking the certainty that we're getting. And I think where we're going to get to is probably an effective tariff rate of roughly maybe 15% or 20%, still high, but I do think businesses will finally have that certainty.
From the low single digits to a number that big, and you think inflation has settled down so much that by the middle to the second half of this year, the Fed can cut rates?
I think it's possible because you're going to have lower energy prices. I think you're already seeing a pullback in discretionary spending with consumers. And again, that's getting one of the key pieces of inflation that the Fed has been struggling to get under control, and that should help to offset some of the price shock, I think, from tariffs.
How much is your faith that there is going to be some further gains predicated on the idea that the U.S. will be once again a haven in a storm, that the tariffs that the U.S. puts on are going to hurt the rest of the world more than the United States?
I think it will. I mean, we import a lot from the rest of the world, more from the rest of the world than others. So I think we're going to be in a situation where it's relative growth. I think what you're having now is some outflows, largely going to Europe, some going to China. But I think once we get into the second half, you get some business confidence with the tax plan. I think businesses will be more confident. You'll get more capital back to the U.S., largely in tech companies. I think interest rate differentials will become a factor again, and I think that'll be positive for risk.
Are you seeing international clients right now interested in coming into U.S. assets?
Right now, I still do see appetite, especially with fixed income. So on the 10-year, you know, the domestic investors are still coming back. I think a lot of foreign investors are still buying the long end of the curve, which tells me that there's still confidence in the U.S.
So what do you think is wrong about this narrative that the uncertainty itself, if continued, and it is likely to continue at least in the very near term, is going to suppress growth disproportionately and actually have a greater chance than not of putting the United States into recession?
Yeah, so I think, again, we avoid recession because I think the tax plan from the Trump administration will put a floor under, at least for the bottom two quintile of income earners. And then you have deregulation, and businesses will have some confidence with things like the 100% bonus depreciation. I think with the consumer, employers, they may not be hiring, but they're not laying off. I think they learned from the pandemic that it's really costly to rehire workers that you laid off. And our labor force is still actually short, still about 1.5 million to 2 million workers. So there is some demand for labor.
No, it's good to see you. Constructive view.
Good
Thank
to
you,
see
sir.
you.
Thank you very much.
Pleasure.
Noel Dixon there of State Street. Equity futures at the moment higher by 1.6%. The opening bell is about 46 minutes away with an update on stories elsewhere. With your Bloomberg brief, here's Danny Berger. Hey, Danny.
Hey, John. Intel has entered into a definitive agreement to sell 51% of its Altera business to Silver Lake, shares up 4% in the pre-market. The transaction values Altera at $8.75 billion. Intel says the deal is expected to close in the second half of the year. Elsewhere, Japan's prime minister says that the country is in no rush to compromise in U.S. trade negotiations. The country's chief trade negotiator is set to visit the U.S. Wednesday through Friday to discuss levies on cars, agricultural products, and foreign exchange with Treasury Secretary Scott Bessent. Blue Origin is set to launch a high-profile all-women crew on its flagship space tourism rocket today. The crew includes pop star Katy Perry and Jeff Bezos' fiancée, Lauren Sanchez. The flight's expected to take off at 9:30 a.m. New York time from West Texas on a roughly 11-minute trip. And that's your brief, John.
Hey, Danny, thanks. Big update there. Appreciate it. Got thoughts, Bramo?
Wow. All I could say is this idea of space travel as this recreational thing for pop stars is really interesting to me. I'm curious, is this going to be the future? 11 minutes in space if you're Katy Perry.
I'm not going to share my opinion. Up next on the program, I'm withholding that. I think you know what it is.
Come on, go ahead.
You know what it is.
Okay.
I just couldn't care less.
Okay.
Let's set you up for the day ahead. We're going to catch up with Annmarie in just a moment from Buenos Aires, Argentina, who's catching up with the Treasury Secretary, Scott Bessent, a little bit later on this afternoon at 4 p.m. We'll speak to her on the other side, live from New York. This is Bloomberg. The opening about 41 minutes away. Equity session highs up by 1.5% on the S&P 500. Adding some weight to that rally from last week, and what a phenomenal rally it was, up by 1.9% on the Nasdaq 100 this morning. So equities up across the board and a big week ahead. Your week ahead looks like this. Tomorrow, numbers from Bank of America and Citi, plus United Airlines coming out with results after the closing bell. On Wednesday, retail sales and Fed Chair Jay Powell will be speaking. On Thursday, an ECB decision plus another round of jobless claims, and we'll get Netflix earnings before the long weekend and the Good Friday holiday. Let's turn back to policy. Annmarie joining us from Argentina ahead of her exclusive conversation with the Treasury Secretary, Scott Bessent. AMH, welcome to the programme. Welcome back, I should say. Talk to me about this first of all, because a lot of people have the same question. Why Argentina?
Well, it's a great question, given the fact that this is an individual who is right now in the driver's seat with trying to get to the bottom of 90 agreements and trade deals. When it comes to Argentina, though, I think it's twofold on why people think the Treasury Secretary is making time, his only second foreign trip, to come here to Buenos Aires. One, you do have this IMF deal that was clinched between Argentina and the IMF board on Friday, $20 billion, Jonathan, and they've given Argentina $12 billion of that up front. In exchange, Argentina is willing to put the peso, their currency, to now start trading more free-floating in a band. The second, and what the local press seem very excited about, but it's very unclear if this can even happen, is that they think maybe the Donald Trump presidency would give Argentina a credit line. This is something that would happen under the Treasury Secretary. What I would say is I'm reading this trip as a little bit more of tea leaves. Javier Milei has been a big supporter of President Donald Trump, one of those handful of world leaders that went to Washington, D.C. for the inauguration. And I think on top of this IMF loan, they want to come here and show a sign of support for him.
Let's talk about the Treasury Secretary himself. At the start of the program this morning, we were speaking to Steve Chiavarone, a Federated, a guest you know well. And Lisa asked him, he's constructive, what it would take to make him bearish. And he said, if I see more Navarro and less Bessent, how important has this transition been to, at least from a perception point of view, there is a belief on Wall Street that Secretary Bessent is now running the show in a way that he wasn't a number of weeks ago?
It's a massive change, and it's a huge perception change on Wall Street. Individuals have called me and said to me they are so happy to now see that as the Treasury Secretary, Scott Bessent, taking the lead on negotiations. This week, he is set to sit down with not just Milei here in Argentina, but also his counterpart, the trade mission when it comes to Japan, as well as the economy minister in Spain. So he is really going to be the face of a number of these negotiations. What people on Wall Street will tell you is they are so happy because they feel like they have an adult in the room, someone that not just understands trade, but understands financial markets and is less aggressive when it comes to the cabinet of rivals than the likes of, say, Peter Navarro or the Commerce Secretary Howard Lutnick.
Annmarie, if we're going to read the tea leaves of both this trip and future trips to come, do we have a sense of who Treasury Secretary Bessent is currently scheduled to speak with when it comes to negotiating with some of the counterparts that we would be dealing with when it comes to trade negotiations?
I think front and center is clearly going to be Japan. We do know that Japanese negotiators will be in Washington, D.C. this week. Also, we should note Japan is a country that the Treasury Secretary has a deep wealth of knowledge about, given the fact that he put on massive trades when it comes to the Japanese yen in his former life as a macro hedge fund manager. And also, I think Japan is a place where the U.S. realizes is such an important ally in the Asia Pacific. And the Treasury Secretary has talked about the fact that do these deals with these 90 countries, with American trading partners and allies, get trade fairer, get the deficit down, and then approach China as one.
One question we were asking Annmarie, and I don't expect you to ask this of him, but I am curious what you would say about Treasury Secretary Bessent, the macro hedge fund trader, versus Treasury Secretary Bessent as the Treasury Secretary, as a policymaker, and frankly, as a politician. Do you get a sense of what the daylight is between those two figures?
Well, Lisa, I heard you and Jonathan talking about this earlier, and this is the question I would love to ask him, but I know he's not able to give me an answer. If he was still running Key Square Capital, what kind of positions and bets would he be putting on when he sees this administration come out with global realignment and trade policy we have never seen in our lifetime? What I will say is something the Treasury Secretary told me, you, and Jonathan in February, that in his old life, he used to be that person, put his ear up against the door, looking over the doorway, trying to understand every next move of policymakers and the domino effect of that and what that would mean for financial markets. So maybe we can ask him, what is your advice for individuals who are sitting in his former seat, putting their ear up against the door and trying to understand what this administration is doing? Because one thing is very clear, financial markets, global investors, even everyday consumers, they want clarity.
Annmarie, appreciate it, and we're all looking forward to the conversation a little bit later on this afternoon. Annmarie sitting down with the Treasury Secretary, Scott Bessent, at 4 p.m. Eastern Time in Buenos Aires, Argentina.
I love that. What would you tell those people with their ears pressed up against the door, especially when they hear 5 different things behind the same door? It becomes a real question about messaging, as well as how he can contain a message that seems at odds with itself, depending on the day.
Consensus would suggest limit long gold. Is that right?
Well,
that's the view of things, right?
That was something that he liked before. I'd be curious to see, right? Because ultimately, this is a difficult moment for him to game out, considering that he is very much a player. So, you know, he wouldn't tip his hand, obviously.
Let's take stock of things, Lisa. So far, a lot of people are concerned, anxious. You see that in the data. What you also see in the data, though, and particularly from the guidance that we've had from Wall Street so far, is a degree of confidence. A degree of confidence that you certainly didn't see in you, Mitch, on Friday, to come out and raise your guidance, JP Morgan, to come out and boost the buyback plan, Goldman Sachs, does speak to a degree of confidence that some of these business leaders still have.
I go back to something Mohamed El-Erian said when he spoke with us a couple weeks ago, and he said there was a 50% chance that we go to a Reagan-Thatcher-like reorganization of world trade that ushers in an era of prosperity, or Carter on steroids, which we embark on a 1970s stagflation, inflationary, and recession-type situation. He moved that down to 35%, 65%. But there still is that upside, and that, I think, is the point.
We'll see if that confidence is misplaced or not. Coming up tomorrow, we'll catch up with Christian Muller-Glissman of Goldman Sachs, Brent Schutte of Northwestern Mutual, Krishna of Lafayette College, plus the Virginia Governor, Glenn Youngkin. Look out for that conversation tomorrow morning. Live from New York City this morning. Good morning. Thank you very much for choosing Bloomberg TV. This was Bloomberg Surveillance.